it would be hard to describe banks as anything other than a value trap for the past 10 years. Right now, we're market weight the sector. I don't want to be underweight the sector, but it seems to me, I don't want to oversimplify it, but it really seems to me that the yield curve has to steepen meaningfully for the stocks to do better.
Jason Trenner, thank you so much. Coming from, I think he's at the Frick Museum today, Francine, with the paintings behind him and all. He is with Strategas Research Partners, and just wonderful. His newsletter is just absolutely stupendous as well. An important thing that Bloomberg's doing, there's been a real commitment here to green, and there will be any number of good guests here during our Green Week. That would include Philips CEO Frans van Houten, Iberdrola Chairman Ignacio Galen as well. Look for that in New York today. This is Bloomberg.
Me gustaría decirle a los empleadores que fueran más humanitarios con sus trabajadores, que les hagan valer sus derechos.
Y estábamos viviendo en dos casas, en unas 50 personas y en la otra otras 50. En cada casa había 5 habitaciones. En cada habitación había de 3 a 4 camas abarrotadas. Vivíamos de 6 a 7 personas. Un baño para cada habitación y una cocina para todas.
Una vez que nos atendieron en el hospital, al salir nos avisó una compañera que ya nos habían reportado a migración.
Gracias a Dios ahorita de salud yo estoy muy bien, pero en lo moral no estoy muy bien, porque a causa de esa enfermedad yo perdí todo, perdí mi trabajo.
Yo creo que mi caso resulta un gran problema de cómo las personas migrantes estamos en riesgo de explotación por parte de los empleadores.
Particularly, sort of the technology landscape have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is Bloomberg Surveillance. I'm Ritika Gupta with your Bloomberg Business Flash. Sony is cutting its estimated PlayStation 5 production because of problems with chips for the console. Bloomberg's learned the Japanese electronics company is projecting it will make about 11 million units this fiscal quarter or year, down from 15 million. Sony is expected to reveal launch and pricing plans for the PlayStation 5 tomorrow. And for the first time, one of the 4 biggest railroads in the U.S. will be run by a woman. Warren Buffett's railroad, BNSF, has named Catherine Farmer its new CEO. BNCSF is a key profit driver as Berkshire Hathaway. Buffett once referred to it as one of the 2 lead dogs of the conglomerate's non-insurance businesses. And federal regulators may take action against Citigroup over deficiencies in its risk and control functions. The scrutiny sped up the timing of CEO Michael Corbat's announcement that he's stepping down next year. Bloomberg's learned that Corbat wanted fresh leadership because it could take years to resolve the issue. And that is your latest Bloomberg Business Flash. Tom Francine.
Rika, thank you so much. Now, we're seeing a bit of positive momentum when it comes to European equities. A lot of the focus is on encouraging data out of China, and then we also had some better than expected retail figures. So European stocks are climbing for a third day, and then, as I was saying, Tom, data is showing that China's economic recovery is actually gaining pace. Oil and gold advancing while the dollar slipping for a third session.
And again, equities lifting in the United States. The Dow level up 28,032, up 161 points. SPX up 21 points, 3393 on the Standard & Poor's 500. I'm watching the VIX carefully, 25.61. Again, the level comes down, the quiescence of the market a little more obvious than we've seen. The 10-year yield 0.68%. It is wonderful always to visit with the comptroller of New York City. Scott Stringer counts the beans, but far more, he has a political future. We'll talk to Mr. Stringer about a transaction tax on the rich of New York City, given the horrific finances, the horrific fiscal realities of the pandemic. Stay with us. This is Bloomberg. Good morning.
Is that your view? You don't need all the people you have, or you may not need them all in the office?
We believe that when people are together, that's a critical element for innovation. So we do look forward to having people back in the office.
Surveillance. Good morning, everyone. Tom Keene and Francine Lacroix. Lots going on again. We've been looking also in London at the Brexit battle. You know, it's a blur to me, Francine, right now. What is the Prime Minister's task today?
Well, the Prime Minister needs to try and convince the House of Lords to pass his Brexit bill, Tom, but it would be reneging on international law. And there is a lot of pressure from within the party to just stop it because, you know, the UK has always abided by international law. So this would be a pretty big twist.
Well, very good. That is London and the battle there. In New York, there is a backstory here. We look at the international, we look at the national, the horrific fires out west. But right now, a 2-hour conversation with Scott Stringer. He went to the Bella Abzug School of Charm and became a politician on the island of Manhattan, has been comptroller, and now will run for mayor. There's 47 things to talk to him about, and of course with Shonali Basak of Bloomberg as well, because there's a lot to talk about right now. Scott, I must start with your aspiration to be the mayor of this great city. What is the Stringer plan to drag this city out of this pandemic?
Well, that is the number one priority. Is we're going to have to do a lot at the same time. One, we have to use our financial chops to slowly and carefully turn the economy on. I would argue that we can't turn the economy on the same way we closed it. We have to be more thoughtful about how we invest in infrastructure, how we invest in the neighborhoods that have just been ripped apart by COVID. So the next mayor is going to have to govern in a serious way to get this economy going. For me, the priority has to be closing budget deficits in a way that spurs economic development and growth in all of our communities. And it's something I'm thinking about not just as a mayoral candidate, but as controller, the chief financial officer of the city.
Within the liberal ethos of New York City, can you go after the rich?
People. My view is, look, here's the state of play. We have a $4.2 billion deficit in our city budget for next year. It's tough, but manageable. So we have to use all the levers at our disposal to close that budget gap. So, for example, we have billions of dollars in reserves. We can draw down on those reserves. We have the opportunity to find more efficiencies in our agencies. Our mayor has never gone through an exercise looking to save money year in, year out. So there's a lot that we can do simply by being good auditors and saving hundreds of millions of dollars. I also have put on the table, as we should, people of great wealth who did great in this city over the last 10, 20 years. They should be prepared, if necessary, to step up and help out as well. When that happens, and we have a balanced approach to balancing the budget, then we're on to something. But everyone has to help it. I would make the argument that we in New York City have watched heroes every single day. This pandemic started with us. We saw frontline workers going to save lives. They didn't have masks. They didn't have protection. They went out. Some people lost their lives. And I think the business community, you know, come on, step up. We need your help. We're all in this together.
Do you have any concerns about members of the business community, members of the wealthier class in New York, leaving New York should you raise taxes on them?
Look, we've had a fiscal crisis as far back as the 1970s. When I was growing up, when, in fact, you're right, my cousin Bella Abzug ran for mayor of New York City. People fled. I remember they left as a kid. They came back. After 9/11, people fled, but they came back. After 2008 recession, people left. They came back. There will be some that will leave, but everyone at the end of the day wants to be in the center of the universe. No disrespect to London. They want to live in New York City. The next mayor has to continue to build on quality of life, economic stability, and also reimagine what the city can look like, whether it's transportation or helping communities most in need. And once that happens, I believe people are going to come roaring back here. And by the way, what I would say to people with a lot of money, why would you risk your life going to Texas or Florida or any place where you have governors who just ignore health safety laws? You got to be nuts to go there. Stay where you are. New York City is the safest place in the world right now.
But the thing is, people were moving there even before the pandemic had even started and before there was a greater push for these taxes. And I'm wondering, there are some executives in the financial industry now that are talking about moving some of their jobs there to potentially lower cost locations for their employees. Are you concerned about that realistically? What can we do to keep the New York City jobs in the financial industry?
Well, look, we have to continue to build a city that attracts business, attracts entrepreneurship, We have to invest in our tech community. We're starting to do that. Life sciences has always been something that has been a foundation for a future economy. We've got to build our schools and invest in our universities, because that's why young people from around the world want to come and get educated here. And when they come here, they always stay here. So we need a strong plan to make sure that we have a robust business community. But we also have to remind ourselves that we have 66,000 small businesses in New York City. They employ 700,000 people. I don't want to see them get squeezed or lost. You know, I do have great expectation that Amazon is going to do just fine, and Facebook will do just fine. For me, we have to double down on our small businesses, those middle businesses that can mean the difference of people fleeing or people staying. But we need a mayor with a plan and somebody who has the strength, management chops to get us through these very tough times.
So, Mr. Stringer, I don't know if I've missed it. I want to go, back to some of the cost inefficiencies you're talking about. But first, would you raise taxes for the wealthy?
I said that we should put everything on the table. Wealthy people, if needed, should pay a little more to get us through this crisis. We have asked our frontline workers to make the ultimate sacrifice. It seems reasonable that people who have great wealth would want to help the city a city in which they made money at. I don't understand this notion of throwing your hands up and running away. This is the time you stay and fight and you build back the city. This is the city that made you great. It's the greatest city in the world. Let's all do it together. And let's all be heroes as we struggle to get our deficit under control and our economy under control. Look, without New York City, the national economy will struggle. We send $22 billion more to our federal government than we get back. And all we're asking for on a federal level is a stimulus package that recognizes the political, not the political, but certainly the economic might of New York City.
So you were mentioning spending inefficiencies. How much can you save by getting that back in order?
I estimate that you could save up to $500 million to $1 billion, depending on how deep you go with those efficiencies. Again, these are not layoffs. These are not efficiencies that would hurt essential services. We have that much fat in our budget. I've done the audits of all the agencies. It exists. We have to flush it out and then reinvest that money in the things that we need to keep going, services in our city, but also to close our budget deficit. You know, here's the deal. In my office, we did a 4% cut. I returned millions of dollars from the controller's office, gave it to the city general fund without them even asking. And it's not that hard. You take a scalpel, not a sledgehammer. You do the hard work of finding those efficiencies, and then you bring them into the general fund to offset the deficit. The other thing that I've offered to do with the mayor is do the kind of refinancing of our city debt. We have low interest rates. I estimate that we can realize $400 million in refinancing, perhaps another $500 million next year. So there's a lot that we can do to stem the tide. It's not just raising taxes. That could be a component. It's not just borrowing, but that could be a component. We have a lot sitting out there to get this deficit under control. We just need the political will. We just need to get to work and do the savings.
To what extent are we facing a New York City that's like the 1970s?
Today, we're not. What I worry about is that we could create our own 1970s story if we don't take decisive action. But we are not on the edge of bankruptcy. Look, I still believe that even with all of the saving measures I'm talking about on your show today, Biden will become president. We will have a real stimulus package that will help government, local and state governments. That's ultimately the way we get out of this. But in the meantime, New York City will do its share, as will, I'm sure, other localities around the country. You know, Donald Trump has given up on his hometown long before the pandemic, and he has been the chief architect of literally poisoning hundreds of thousands of people. And that era hopefully comes to an end politically. We just have to hold on until help is on the way, and hopefully that will come in November.
Mr. Stringer, thank you so much. Scott Stringer is a New York City comptroller. Sonali Basak, thank you so much as well. We'll talk to Sonali about Citigroup here when we get the story straight. We will see. Our first word news in New York City. Here's Ritika Gupta.
Thanks, Tom. Italy has ruled out pulling out of trade deal talks with the UK. That's despite the move by British Prime Minister Boris Johnson to renege on part of the Brexit divorce accord. Bloomberg spoke with Italy's Minister for European Affairs.
We always have been united, backing Michel Barnier, the work of our negotiator, and so we are going to have this line until the end. It was successful to sign the withdrawal agreement, and I hope, and we are working for having the same success in order to plan our common future. Negotiating is always one of the mainstream of the European Union tradition, so we are a tough negotiator, but also we are working to find a way out, always.
The European Union has threatened legal action. It's called on Johnson to withdraw the bill by the end of the month. The economic recovery in China sped up last month. Retail sales rose 0.5% from a year earlier. That's the first increase since the coronavirus hit early in the year. Meanwhile, China's industrial production rose for the first time in 2020. And in baseball, billionaire investor Steve Cohen has a deal to buy the New York Mets. Cohen reached an agreement with the firm backed by the team's owners, the Wilpon and Katz families. Terms of the deal weren't disclosed. The website Sportico previously reported that Cohen's offer valued the team at $2.4 billion. He already was a minority investor. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom Francine.
Ritika, thank you so much. Greatly appreciate that. On the streaming wars, on the future of media, odd things going on, even the future of cinema and networks. Robert Bakish, Viacom CBS President and CEO, this afternoon. This is Bloomberg. Good morning.
We never thought COVID-19 is going to hit us, but now looking back, I don't know how we could cope without this new sector.
Hong Kong is not by itself a big market, but because of the growth GBA, there's huge opportunity. So we're seeing a huge wave of biotech innovation coming in the past few years.
Almost kind of certain that at the very beginning of our journey to pursue the biotech listings, we'll see a lot of the Chinese companies.
This is just the right thing to do at the right time, and it's such a big sector.
We have a second product for approval, and now are actively preparing for the commercialization. And we're expecting to have 2 more products to be approval before end of the year. So we have a high confidence that we will meet the expectation.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
If we ignore that science and sort of put our head in the sand and think it's all about vegetation management, we're not going to succeed together protecting Californians.
Okay, it'll start getting cooler. You just watch.
I wish science agreed with you.
Hey, well, I don't think science knows, actually.
A weather report from the President of the United States. Joining us now, Kevin Cirilli. We say good morning to all of you as well, our chief meteorologist in Washington. Kevin, I'm advantaged by a glorious sunset. The sunset looked like Mandalorian last night. I think the Boston Herald seeming out front on some of this fire and dust is even moving over to the east coast of the United States. How will that play politically in those key swing states?
Well, look, I think when you've got 3.3 million acres in California, a record in terms of the wildfires that have just ravaged parts of Oregon, Washington State, and Northern California, this is a natural disaster of epic proportions during the middle of hurricane season. There's more than 16,000 firefighters, Tom, who are in Northern California alone that have been lumped into this in order to combat this. And we saw the effect yesterday. That's a long way of answering your question. It pushed the issue of climate change front and center of the presidential debate.
And are people behind what the president is saying? I mean, for our international audience, sometimes it's difficult to get your head round, Kevin, about how many people don't believe in climate change in the U.S.
Well, Francine, look, I think that there are many Republicans who do believe in climate change. The ideological debate is over how to combat it, and so whether or not the private sector should work with the public sector in order to form a partnership that would innovate their way out of climate change versus what the Democrats have put forth. But to your point precisely, the Democrats have framed the debate largely, and yesterday the president to some extent playing into that framing by doubting the science that has led to the issue at hand. And so I think when you look at polls for young people in particular, as well as to some extent the independent voters in suburbs, climate change is an issue that Democrats feel will help them politically.
Kevin, is Joe Biden getting through to voters? I keep on reading that if he's going to win this, he needs to try and convey some kind of hope for people that have been or feel they've been forgotten. Is that working?
Well, Francine, I mean, when you look at the polls in these swing states, they have increasingly tightened. However, he has consistently been polling ahead of President Trump. Now, on the issue of the economy, that's the one area where President Trump has been able to hang on, where he has been able to outpoll nominee Biden. However, when you look at how voters right now, as of now, are ranking the various issues, the pandemic, racial unrest, as well as other issues, are beating in some cases the issue of the economy. If that holds come November 3rd, this would be an anomaly election because typically for a president up for re-election, if the economy is the #1 issue, then the incumbent wins. But right now, the economy is not polling at the #1 issue, despite the president beating Biden on the issue of the economy. If Republicans want the upper hand, they've got to flip that and make the economy beat out these other issues.
Kevin, this is probably the hardest question I've ever asked you. If you're an undecided voter in the U.S. right now, what makes you decide who you vote for? Is it a debate? Do we need to see more head-to-head debates, or at least one debate, or is it on policy?
Look, I'm going to take a breath and pause there. I think that there were 70,000 voters who really decided this election last cycle. They had previously voted for Obama, then they voted for crossed over and voted for President Trump. We talk about that parts of America virtually every day on this program. What they're looking for is, will the pandemic become an economic issue, or will it maintain as a health crisis? The Middle East will be front and center at the White House today, with Israel at the White House. And when you look at the lockdowns that they're having to reimpose, the pandemic in Israel has become a health concern much more than an economic one. Should that play out here in the United States, or should we see what's happening in Brazil, for example, here in the United States? Then, we don't know. Should the U.S. go the way of Brazil and it become an economic issue? That's the advantage for President Trump. Should the U.S. go the way of Israel and additional lockdowns are imposed? Arguably, that's an advantage for nominee Biden if it's a health concern.
Thank you so much, our Kevin Cirilli there, Bloomberg Chief Washington Correspondent. Now, make sure also you catch the Bloomberg Green Festival. It starts today, but it's all week long. It starts today at 8 a.m. in New York. That's 1 p.m. in London. Up next, Andrew Murtha. He's at Johns Hopkins International Research Vice Dean. We talk China, and we talk the economy. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, China's economic recovery sped up in August, led by the first growth in retail sales since the pandemic first hit and an acceleration in industrial output. Now, joining us is Andrew Murtha. He's Johns Hopkins International Research Cooperation Vice Dean and China Studies Program Director. Andrew, great to have you on a program, especially on a day where, you know, the Chinese economy seems to be doing a bit better than some economists had expected. Does this trend stay, or could it fall back out very quickly if the number of infected rises?
Well, thanks. Very nice to be here. It seems, according to a number of analysts, it seems to be somewhat. It seems to be somewhat stable, and it's going to likely continue kind of modestly. Not kind of dramatic recovery that maybe some would like, but it really is, I think, dependent on whether or not we do see a resurgence of the virus, because it really does seem to be a combination of growth in manufacturing, but also the behavior of consumers. And consumers in China, I think, tend to be a bit more sensitive to, or they have a kind of a greater degree of concern over the health issues, so that we see the rise of automobile manufacturing, for example, and exports and construction, but at the same time we see a drop in cinema box office revenue, and so those things point to the Chinese consumers kind of trying to play it safe when it comes to their health.
Andrew, do you worry about some of the Chinese banks actually facing a cash squeeze? We saw PBOC adding extra liquidity to make sure that does not happen.
So the banking sector is always something that's a little bit, always seems to be standing at the precipice of some sort of intervention by the state. What I'm a bit more concerned about is the degree to which Chinese investments abroad. We haven't heard much of the Belt and Road Initiative in a long time, but we'd heard nothing but for months and years. And one of the questions is, how do the countries that are on the receiving end of Belt and Road, who have been recipients of Chinese largesse, how do they pay back the loans, or how do they essentially restructure their economic and kind of investment ties with China?
Andrew, talk to me a little bit about what we learned this week. So, China, or at least a senior Chinese official, came out with pretty strong words today, saying that the sale of TikTok in the U.S. is basically bullying. And he also lambasted EU restrictions on Huawei. Are we going to see a much more belligerent China, or is what happened with TikTok and the possible sale to Oracle an elegant solution where both sides win?
So I'm much more on the side of the latter. I mean, this is an old-fashioned compromise that we haven't seen in some time. So that Beijing gets to keep, or China gets to keep the algorithm, and the United States is able to house the sensitive data of U.S. citizens. Now, that's also subject to approval by the Trump administration and report by CFIUS. But my sense just today, in hearing the Chinese response, is that that's what we would expect to hear. But this is the kind of thing that, if it weren't as high profile as this, would be kind of the rules of the road in terms of finding compromise between the United States and China.
Andrew, thanks so much. Andrew Murther of Johns Hopkins. Now, stay with us, because coming up next, join Tom Keene, Jonathan Farrow, and Lisa Abramovitz for more Bloomberg surveillance, but this time simulcast on radio and TV. This is Bloomberg.
Ada 3 kelompok pengungsi tersebut yang sudah berpencar arah. Kemudian kami dari Polsek Banda Sakti berkoordinasi dengan perangkat desa Kampung Jomblang melakukan upaya pengumpulan secara persuasif serta minta tolong kepada warga. Alhamdulillah warga yang terpecah semuanya berkumpul.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
The cybersecurity sector obviously is no secret that it's probably going to do very well in the next 5 to 10 years, say. 2020 has already surpassed previous years' funding in digital health in particular.
I personally prefer to buy businesses that make money, and if you can buy them that are unlevered, that just means they're even cheaper.
Classic style value that we know is dead.
The longer term is not looking good right now in terms of the support for consumption.
A lot of the stuff that is priced cheaply right now is a structurally impaired sector that was probably impaired before the crisis and looks even worse now.
Dollar is weakening. Rest of the world is recovering faster.
Bond investors are sleeping on a dynamite pillow, and that dynamite is inflation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramovitz.
From New York and London for our audience worldwide, good morning, good morning. This
It's Bloomberg Surveillance Live on Bloomberg Radio and TV. Alongside Lisa Ravitz and Tom Keene, I'm Jonathan Ferro. The two-day Fed meeting, Tom, begins right now. 24 hours away from a Fed decision. And I've got to say, this equity market, Tom, bouncing back big time in the last couple of days.
No, bouncing back. I would really go to China on this. I thought Steve Engel this morning, John Farrell, was really scintillating about how China's doing better than good. You see it in renminbi stronger as well, and we get a nice lift. But to your point, John, I can't remember a Fed meeting where I've been more distracted by other news.
Because the other news probably matters more, Tom, because at the moment, the Federal Reserve, as far as everybody's concerned, is basically done. When it comes to the framework shift, we've seen that. When it comes to the balance sheet, we've seen a huge expansion. I think there'll be tweaks around the edges, Tom, but for many, many people right now, the most important catalyst on the policy front is fiscal down in Washington.
Well, it's fiscal based off weak aggregate demand. I'm going to give you one vignette, folks. It's so important, and I can't remember where I saw this. I'll give you Axios credit. John, it was a food bank in Richmond, Virginia, by automobile. And the line, it looked like Field of Dreams. The line of cars went off into the distance, and it was just shockingly sad how people were lined up to get food. They were having that much difficulty.
Tom, couldn't agree with you more. We're living in two worlds right now, and Lisa spoke eloquently about this over the last couple of months. Lisa, the old world and the new world. The old world is struggling. Job cuts, you see it all over the place, particularly in the airline business. Saw it with Airbus, the plane maker, in the last 24 hours, talking up the prospect of more of that still to come. The new world, Amazon, out there buying 100K, investing in 100K employees. NVIDIA, buying SoftBank's arm, SoftBank buying call options in the equity market. Two different worlds, polar opposites.
And there's a question of how the economic data reflects this and whether it reflects it accurately. And Paul Donovan of UBS, who we're going to be speaking with later this morning, he said in a recent report there's an absurd level of trust that economic data is accurate and a failure to challenge what the data is saying. And I think that that is a salient point at a time when we're getting economic data and markets don't know how to read it, John. That is a key concern. Question how the Fed is going to read it as well.
What's coming up, Lisa?
All right, we're going to be looking at some of that economic data today at 9:15 a.m. U.S. August industrial and manufacturing production. Expect more of the same. Looking for it to confirm the popular perception that the easy gains have already been gotten. 1 p.m. I know that Tom really likes bond auctions, so I wanted to mention that the U.S. is planning to sell at $22 billion of 20-year bonds. It's
like
higher.
An Arsenal pregame.
Oh, I know that you watch this very carefully. People are wondering how much investors are going to be piling in the Fed and perhaps pulling back a little bit as a buyer. Also today, John, as you're talking about the FOMC gathering for its two-day policy meeting, very much in the forefront. Inflation. What, Tom? Inflation.
John,
I want to know
there's
about
a
inflation.
fourth morning
What are you complaining about, Tom?
Steve Cohen's taken out the Mets, and Abramowitz is rumored to be the new first base coach.
I'm going to spare the Mets
Lisa's
further
team.
agony. Let me just explain something.
Please.
The Wilpons are not a loved management of the Mets. People are hopeful that Steve Cohen will be better.
Lisa, what is Steve? This is serious now. When we say, major shout out to Scott Soshnick over at Sportico, who broke this. Lisa Abramowitz, what does Mr. Cohen need to do to turn around the sorriest franchise in baseball?
He needs to lower the pay and increase the results. I mean, honestly, that's the bottom line. They're already losing. They're already at the bottom of their conference, and it's been a short season, and they are a very expensive team, the most expensive possibly.
Look at that passion. John, this show is completely derailed. Look at the passion.
All right, let's move on to economics. Come on, no one needs to hear me talk about baseball.
Do you know what I love from Lisa? She's got this one line. Let me tell you something.
Yeah.
Let me translate. When she says, let me tell you something, it means you're all idiots.
Thank you. You're right.
Something.
All right, carry on, John. What are we looking at today?
You'll hear it repeatedly over the next couple of hours when she refers to Tom and me. In this market right now, we're up 24 on the S&P 500. We advanced 0.7% on the S&P. A real lift to this equity market. In the bond market, little bit of curve steepness on the morning. Yield up by almost a basis point to 0.68%. But I've got to say, the range in treasuries has really, really howled.
Yeah.
And how many people think it's going to break anytime soon, Tom? That's a question. Euro dollar approaching 119. A weaker dollar on the screen this morning, Tom.
Well, tie a bow around that. The real yield has come in just a little bit. It's not a big deal, but there it is, John, under a negative 1%, negative 0.98. That is a lesser negative statistic.
Joining us right now is Ben Mandel, JP Morgan Asset Management, Multi-Asset Solutions Global Strategist. Ben, great to catch up with you, sir. This is in your most recent research. It's about the bond market. Where do you get that downside protection from if the equity market falls out of bed? What's the answer, Ben?
Well, it's a difficult question. With all difficult questions, I think it depends. Let me say first that the underlying trend here is a positive one, based on fundamental factors. You have slightly early cycle dynamics. It's well flagged that the Fed has providing ample monetary policy support. The balance of risks on the upside and downside is pretty good here, but it's a portfolio construction headache in the sense that your usual sources of protection are no longer active. So the most impressive thing of the last month has been just the fact that bond yields do not move. You had a point where U.S. equities were down 4 or 5%. Bond yields, 10-year treasuries were down 2 basis points. And so that negative stock-bond correlation is no longer a source of balance in portfolios. And the question is, how do you get that? So the answer, I think, is that you have to assemble a set of more constructive, favorable correlations in your portfolio. One is credit. So if you're taking a pro-risk view, positions in credit are not perfectly correlated. And in fact, because of the Fed put, because of the implicit and explicit guarantees from the Fed, credit has been much less sensitive to swings in the equity market. So that's one. The second is the dollar. So everybody's talking about how the dollar is going to depreciate in trend terms. It's also the thing that has the most favorable correlation when things go wrong. So if everything goes right, the dollar is going to continue depreciating somewhat. If it goes wrong, there's no limit to how strong the dollar can get. So you have to use those correlations as a hedge in your portfolio.
Ben, I saw yesterday that hedge funds bet on technologies flipped. I'm going to give credit to Zero Hedge. I frankly, folks, can't remember where I saw it. Ben, how important is it to go with hedge funds in their belief or to bet contrarian to them? Which way does that cut?
Well, average returns for hedge funds over the last 20 years have not been spectacular. So maybe you'll take that as a contrarian indicator. But I think, you have to focus on what those directional trends are. And I don't think we're not looking at that as a singular indicator here.
What is your indicator on technology funds? Folks, Ray Dalio coming up this afternoon, Catherine Burton with a blistering article this morning on Bridgewater as well. Is that the salvation for hedge funds to go the other way and pile into tech?
I think it raises an important question for us in terms of, are growth stocks going to continue to lead here and the relatively narrow foundation on the U.S. market? I think this actually feeds into the same concept of where's protection in your portfolio. And, typically we think about the U.S. equity market as the high quality, high return on equity market, and hence somewhat defensive when things go wrong. Actually, that's not the case these days. The volatility, especially when tech is leading, is very much centered around the U.S. and as such, it's a higher beta market. So I think what that's telling you is that as you diversify internationally, that those equity positions, you're looking a little bit less in the U.S., a little bit more outside for that balance.
Ben, when you say outside, are you looking to China, given the strength of the recovery that we saw in the data last night?
Yeah, you want things that are levered to things that are going right in the global economy, and goods is the thing that's going right and will continue to go right for the next few months. You have consumer demand, which you saw to the China data, but you're seeing pretty much everywhere. We're not in the blisteringly fast growth that we saw in May and June, but the consumer is very much in recovery mode here. You're seeing incipient signs of CapEx recovering, and so you have both on the firm and the household side demand for goods, which is fueling industrial activity, and then the inventory cycle is amplifying that. And so things that are levered to goods, markets that are levered to goods are going to do well here. That includes emerging markets, that includes to some extent Europe. And so thinking about U.S. large cap, EM and Europe as your combo of overweights in your portfolio seems to make sense.
Hey, Ben, great to catch up. Ben Mandel there of JP Morgan. That final point there, Tom, really, really important. Manufacturing easy to turn back on after the pandemic and the shutdown that we saw almost worldwide. Services much harder. The consumer much, much harder to do. What we're seeing in China, I think, is really important. The switch back on manufacturing and retail sales was where the outperformance was. So the consumer's starting to pick up again. That's what we want to see, not just across the United States, but across Europe too.
I think it's very difficult, John, to transfer China economic dynamics over to any other platform, including the United States. But John, we just talked to Scott Stringer, running for mayor, the comptroller of New York City as well, and he went right to it. The spread between J.P. Morgan and James Diamond and 12 small businesses on 3rd Avenue has never been greater.
Couldn't agree more, Tom. And there's going to be problems still ahead. Let me tell you something here in the United Kingdom. The phoniest piece of economic data on the planet in the world of economics right now, the unemployment rate in the UK at just north of 4%. Because when this furlough program ends, set to end at the end of October, Tom, that unemployment rate will look radically different if indeed they allow it to end in a month's time. That's the story at the moment, Tom. Still struggling to get a read on this economy, not just in the UK, but worldwide.
Oh, absolutely. I mean, it is worldwide. And, of course, you really wonder to that point, John, the Fed meeting tomorrow, is this a Fed meeting about the United States of America, or is this the central banker to the world?
I've got to say, and Lisa might want to weigh in on this, I think that the central bank's got a tough job tomorrow in the same way the ECB did last week. The Fed's going to have to upgrade its forecast. Their forecast on unemployment is too depressing compared to where we already are. In fact, the unemployment rate, Lisa, right now is already below where they see the unemployment rate year-end.
Let's go to the depressing one to find out. Lisa?
Thanks a lot, Tom. Let me tell you something. It's pretty depressing out there. I will say, no, this is listen, I do think that this is important, though, that actually the data has not been as depressing as people have expected. It's continued to surprise to the upside. And I think, John, this is what the Fed is going to try to reconcile, all the pain that we're seeing with data that isn't reflecting it to the degree that many people expected.
You realize you're exposed now, don't you, Lisa? This is it. Everyone's going to start playing a drinking game with this. Let me tell you something.
1,000%. And you know what? If you get me a bottle of wine, I'll play it in the morning. Let me just tell you.
I'm happy to see you drunk on Bloomberg Surveillance in the morning. Then there's two of you from New York and London. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. On Capitol Hill, it's a long-shot attempt to break the deadlock over another coronavirus relief bill. A 50-member group of House Democrats and Republicans will unveil a $1.5 trillion stimulus package today. It offers compromises on the two thorniest issues, aid to state and local governments, and supplemental unemployment insurance. Hurricane Sally slowed slightly overnight in the Gulf of Mexico. It's now been downgraded to a Category 1 hurricane with winds of 85 miles an hour. Sally will make landfall tonight or early tomorrow, but exactly where is difficult to say. Hurricane warnings extend from New Orleans to the Florida Panhandle. There are fears the hurricane will bring a deadly storm surge and flooding. And Bill Gates used to think of the FDA as the world's premier public health authority. Not anymore. The billionaire philanthropist discussed politicizing COVID-19 treatments and vaccines in an interview with Bloomberg's Eric Schatzker.
And any suggestion that, a politician, helped create the vaccine or it's faster because of a politician is a very dangerous thing. We saw with the completely bungled plasma statements that, when you start pressuring people to say optimistic things, they go completely off the rails. And so the FDA lost a lot of credibility there.
We'll have more of that interview with Bill Gates coming up on Bloomberg TV. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
has been interrupted. Uninterrupted service is peace of mind. Kimi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Suggestion that, a politician, helped create the vaccine or it's faster because of a politician is a very dangerous thing. We saw with the completely bungled plasma statements that, when you start pressuring people to say optimistic things, they go completely off the rails. And so the FDA lost a lot of credibility there.
Bill Gates there, the Microsoft co-founder, trying to separate the politics away from the vaccine effort. Big story over the last several months from New York City and London this morning. Good morning to you all. Here's your price action. 2 hours and 12 minutes away from the opening bout, trying to get away from a 2-week loss on the S&P 500. We bounced back yesterday. We continue today. We're up 0.7% on the S&P 500. In the FX market, a euro approaching 119. I imagine exactly where the ECB does not want the euro to be, but that's where we are right now. And in the bond market, ahead of that Fed decision, 0.68%. We keep saying it, Tom. Yeah. It's a snoozer in the Treasury market. How much longer will that be the case?
In the equity market, the VIX 25.50 has been a remarkable story over the last, say, 10 days or well. It is the right angle of New Jersey. It is the 5th Congressional District. This is buttressed up in northwestern New Jersey. It's a really, really twisted and interesting district, which goes moderate. And this is about moderates. It's about those close elections out there of 52 to 48%, et cetera. Kevin Cirilli is expert at these districts nationwide. And Kevin, the 5th district in New Jersey brings us to this Eric Wasson report today of a $1.5 trillion moderate stimulus bill. Is it dead on arrival?
Well, look, this is the ace up the sleeve of Treasury Secretary Steven Mnuchin, who had been referring to a third option in terms of the stimulus. They're known as the Problem Solvers Caucus. It's a group of about 50 members of moderates, Republicans and Democrats both, that have been working privately behind the scene. And in just a couple of hours, as Eric Wasson reports, they're going to be unveiling a $1.5 trillion stimulus package. It splits the difference, Tom, on a host of different issues, including the issue of unemployment insurance at about $450 per week. And it's something that McConnell and Pelosi couldn't get their respective camps that are entrenched on both sides to agree to. We'll see if there's a narrow path to a stimulus.
Kevin, the important point here, and I mean, you've been so good on this, is these moderates are people that really, really, really risk losing in this election. They usually win by close votes. Does McConnell and Pelosi care about them?
Well, this is an opportunity for Congressman Gottheimer as well as Congressman Reed, a Republican from New York, a New York Republican, to really throw around their type of clout. They would have, should they be able to secure this monumental political capital heading into there being a compromise. It's also an opportunity, rather, for the White House to really back a moderate proposal that could sell well in the districts. You know, I think from a broader standpoint, many of these Democrats, and I'm sure they don't want me to say which ones, in the Problem Solvers Caucus, are having private conversations with senior members of the administration on a host of different issues pertaining to stimulus, and they have for quite some time. On the issue of the state and local tax deduction, for example, they were a key group that were on the phone with the White House and meeting with the White House privately in order to alleviate some of their concerns.
What happens on the stimulus bill today, this moderate bill? What are you looking for in the next 24 hours?
Well, you know, yesterday when I spoke to some lawmakers, they were very skeptical that anything could get done before the November 3rd elections. But I think ultimately the $1.5 trillion price tag that has been touted on the Freedom, or as the price tag on the Freedom, or on the Problem Solvers Caucus proposal is something that the markets had baked into their expectations. So, you know, it's a narrow path. We'll see if it gets any pickup, but we'll have to listen. What I'll be listening for is Speaker Pelosi and Leader McConnell to see if they are going to be on board with this.
Well, Kevin, let's talk about substance. The enhanced unemployment benefit, 600, that's what it used to be. 450 is what could be in this bill. I'm trying to work out who's going to be more upset, the White House because it's more than 3, or Democrats because it's less than 6.
Well, I think both camps will be, in terms of the far left and the far right, will be frustrated at this. But the question becomes, will they say, you know what, this is as good as it gets for right now? Is this an opportunity for Speaker Pelosi to say, this isn't my idea, this is the moderates' idea? And will they be able to peel off any of the progressives who then could sell to their district that they had originally fought for something more progressive, but had ultimately ended up at the negotiating table and been able to deal with this?
Kevin, is this the last chance for Congress to pass another fiscal support plan?
This is the last chance before the election. But then I think in a lame duck session, that's where things get more interesting. There are a handful of various unemployment benefits as well as industry benefits, Lisa, that expire at the end of the year. So the artificial cliff that exists for the end of the month in terms of keeping the government open for September 30th, the next artificial cliff is December 31st.
But politically, Kevin, wouldn't the president want to pass an additional round of fiscal support? I mean, wouldn't the president be trying to push this through, or is he basically of the mind at this point that the economy is recovering well enough on its own?
You know, I think politically speaking, based upon my reporting, Lisa, there is definitely incentive for President Trump to advance some type of fiscal stimulus. If we go global for a second, if you look at what's happening down in Brazil with Bolsonaro really being the benefit of fiscal stimulus that has helped him in the polls, there's an example of how the economy has surpassed the issue of the pandemic in a country like Brazil. If you go to Israel, for example, where they have reimposed lockdowns for 3 weeks, that one could make the case could be politically advantageous to Democrats. So yes, absolutely. The ability to compromise with moderates at a time when the president is struggling politically in suburbs, definitely one could make the case that that would be politically advantageous.
Hey, Kevin, great to catch up with you. As always, Kevin Cerulli there, Bloomberg chief, Washington correspondent. Might be politically advantageous for someone, Tom. The important news is that this could be good news for the economy and for the people going through some pain right now. And I think that's got to be the big takeaway. 11 a.m. Eastern, I understand, is when we need to look out for that news conference.
We'll have to see. I mean, the desperation, as Lisa mentioned, is like now or never. We're there. I mean, you know, we've been talking about this, John, through all of August as well. Well, guess what? It's the middle of September, and now or never is here.
I think, Tom, to be fair, and Lisa might agree with this, Lisa, I think we've been talking about this since we passed the last bill. Ever since.
Fair.
Just waiting to calibrate, recalibrate the next effort, and it never came.
Yeah, it never came. And now I think the tone is shifting. And there are more people saying perhaps it's not as needed. And that's what I'm watching. The idea that the data is coming in better than expected. How much momentum is there? Is there validity to this, or are people blind to what's coming if we don't get more support, John?
Let me build on that. Tom, the tone is shifting. It's shifting in the C-suite. I think it's been really interesting the last couple of weeks. We had Michael O'Leary of Ryanair. Let's get back to business. We've got Citi in the last 24 hours, reports of resuming job cuts. JP Morgan telling everyone to get back to work. There was a stigma attached to that kind of language a couple of months ago.
Yeah.
Now the C-suite's feeling bolder. Let's get back to business and get things done.
I would say two things. One is you're absolutely right, but to me it's much more strategic, as with Citigroup. There's substantial cuts even as they bring in risk managers. And the other is money is free. In the last hour, Carnival is going to try to raise $1 billion in equity. The beleaguered cruise line. John, money costs nothing right now.
It might cost something for the likes of Carnival, though, Tom. We'll talk about that later. This is Bloomberg.
never thought COVID-19 is going to hit us. But now, looking back, I don't know how we could cope without this new sector.
Hong Kong is not by itself a big market, but because of the growth GBA, there's huge opportunity. So we're seeing a huge wave of biotech innovation coming in the past few years.
Almost kind of certain that at the very beginning of our journey to pursue the biotech listings, we'll see a lot of the Chinese companies.
This is just the right thing to do at the right time, and it's such a big sector.
We have a second product for approval, and now are actively preparing for the commercialization. And we're expecting to have 2 more products to be approval before end of the year. So we have a high confidence that we will meet the expectation.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
2 hours away from the opening bell in New York City. Good morning to you all. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. Let's get you that price action, shall we? On the S&P 500, a lift. Ahead of that open up 0.7%. A lift yesterday too. Keep waiting, Tom. I'm sure it'll come. Euro dollar 119. We advance 0.25%. Some dollar weakness through G10, and in the bond market 0.68%. Is your yield. Tom, I promised you this. Carnival debt. They came out with an issue, a 2023 note, in early April with a coupon of in and around 11%, 11 to 12. The effective yield now, 6%. That just gives you an idea of how much that particular note has rallied and how much spreads have come in as well. It's a double B piece of debt, Tom, and it's really performed well over the last several months.
And as my sainted grandfather said when people said bonds weren't fun, he said, you can't make money in bonds. Think of the price appreciation from 11% to 6% as well. I want to note first, folks, oil lifts today off that 37 level in West Texas Intermediate. It's got to be a good feeling about China, maybe an economic growth. To speak of the American economy, Lindsay Piegza joins us right now with Stifel, their chief economist. Lindsay, John Farrell brought up 20 minutes ago the idea of the all-in United Kingdom unemployment rate. What is the all-in U.S. unemployment rate? Is it double-digit?
It could be. Right now, of course, we know that the civilian rate, the rate reported from the BLS, has come down to 8.4. And we do know that there has been vast improvement from that peak that we saw early on in the pandemic, but we don't know if that's fully capturing what's been happening out in the labor market. As you said, the true unemployment rate is much likely to be closer to that double-digit range. But as we wait for the Fed's decision later this week, tomorrow exactly, we do think that the Fed is going to emphasize that improvement that we've seen in the labor market, that further growth that we've seen in terms of hiring, that further decline in the unemployment rate, as well as the decline in jobless claims. So the Fed is going to be focusing on the improvement that we've seen, as opposed to some of that more tertiary or secondary numbers that suggest a higher level of joblessness in the U.S. labor market.
And then they're going to get to the November 5 Fed meeting, which I assume is going to be a virtually silent meeting just with respect to the American election. We may not even have results by then. Lindsay, I want you to take us out to December and into 2021. What's the economic run rate right now?
Right now, the economy does seem to be improving. We are seeing improvement, as I mentioned, in the labor market, in the housing market. We've seen improvement in the manufacturing numbers. So it does suggest that the U.S. economy is rebounding from that extremely low level that we saw in the second quarter. But I hesitate to say that we're in the position for a V-shaped recovery. As the Fed has pointed out, COVID remains the #1 risk to the outlook. So we can't get complacent at this point yet. There still is a tremendous amount of risk that the virus poses to the economy, that it poses to the outlook. And if we need to, we should remain very vigilant in terms of the safety protocols, in terms of wearing masks, social distancing, in order to keep the economy open and continuing to move towards that point of full employment. But I don't think we're there yet. And we do run the risk of a second wave of cases, a second round of layoffs, which could keep the economy very anemic going into 2021. And this is exactly why the Fed has said that they're not even thinking about raising rates at this point. Interest rates are likely to stay in this very near zero range, this very low range for the foreseeable future, for several years to come.
Well, Lindsay, let's talk about how they manage that message tomorrow then, because tomorrow, surely the unemployment forecast has to get an upgrade given where unemployment has come down to.
Absolutely. We do get that summary of economic projections, and the unemployment rate is likely to be lowered in terms of the Fed's forecast, reflecting the improvement that we have seen in the labor market. I wouldn't expect much change around the inflation figure. I wouldn't expect much more optimism to be priced in terms of their GDP forecast. But you're right, the unemployment rate, their forecast is likely to come down, again, reflecting that improvement. But I think it's more important what we hear from the chairman during the press conference. And he's going to be very careful to walk that line between patting the Fed on the back, saying the swift and decisive action that we took helped stem a further downturn. So the conditions that we saw in the second quarter could have been much more dire. And again, balancing that against the risk. As I mentioned, the virus still remains out there. Businesses have been able to stem that bridge in terms of staying open for several months. But if we don't see a meaningful way of separating the healthy from the sick, or if we don't see additional fiscal stimulus to help bridge that gap for businesses and the American families, it's going to be very difficult to keep the U.S. economy on this pathway back to a more prosperous and sustainable growth level.
Lindsay, there seems to be a divergence between the C-suite in America and economists. The C-suite saying we're seeing better than expected business performance across the board, and you have economists saying, well, you do now, but as this fiscal support runs off, you will see it lose a lot of luster. Have economists lost credibility in a meaningful way, or are they looking at something that perhaps the C-suite isn't seeing?
I think right now, I think most of management, most of corporate America is focused on the near-term outlook, and they're focused on the minimal improvement that we have seen from those low levels at the onset of the pandemic. I think economists are taking more of a longer-term picture, a longer-term view of where the economy is headed. Remember, the economy was already losing momentum as we were heading into 2020. We had slowed from a 3% growth rate down to 2%, yet corporate America was still elated with the prospects of continuing the expansion. So economists were already recognizing that loss of momentum, and I think that loss of momentum has carried through and kept the economy in this extremely fragile position. Then you layer on this pandemic, and it's going to be increasingly difficult for us to get back to a more sustainable organic level of growth. So it could also be that corporate America has become complacent with this unprecedented support from monetary and fiscal policies.
Okay, so if we don't get another fiscal round of support, where do you see the year ending with respect to the U.S. unemployment rate?
I do think that it's going to remain elevated in this 8 to 9% level. I don't think we push back towards that double-digit level that we saw, again, at the onset of the pandemic, but the labor market still is under an extreme amount of pressure. Again, businesses have been able to recall some workers. We have been able to see some new payrolls created, but if we don't see additional fiscal stimulus, if we don't see additional federal funding, if we don't see that vaccine, it's going to be difficult to continue these conditions that have allowed businesses to take on those new hires or to rehire some of those workers that have been pushed to the sidelines. So we could actually see a second wave of layoffs or furloughs towards the end of the year, which would keep that unemployment rate artificially high in that 8 to 9% range.
Lindsay Piegza, yesterday, William Gross talked about a $6 trillion need, a $6 trillion deficit call. Others have come up about that number as well. We're talking 1 and 2 trillion as an arguing point. Are we able to go out and find 3 or 4 or 5 or 6 trillion of new debt to fold onto the American balance sheet?
think we could. The question is, do we want to? We have to be very careful. We want to make sure that we're providing enough stimulus in the near term to get the economy back on track. But we also don't want to create additional barriers on the back end when the economy does begin to recover. Are we struggling under this insurmountable amount of debt that creates future barriers for growth and future generations? So I do think it's a delicate balance. We want to make sure, again, that we get the economy back on track, but not just in the short term, that we're putting it on a longer term trajectory towards a higher level of prosperity.
Lindsay, how delicate is that balance right now? And I ask that in all seriousness with 10-year yields at the moment at 0.68%.
I think it's extremely delicate. As we've seen, the deficit, the total debt held by the American public at record levels. In fact, debt to GDP is the highest level that we've seen in post-World War II history. So we are on an unsustainable trajectory in terms of continuing to load debt onto the balance sheet. That being said, there's not much we can do during these unprecedented times. We have to take on additional debt, but we don't need to be irresponsible about it. We want to make sure that the programs that the federal government is putting into play is going to those that need it, is going to the businesses that need it to continue to bridge this gap. We don't want fraud, or we don't want abuse of these programs. That's very important at this point. And I think the American public has a much lower tolerance at this point for any sort of fraud around those programs, given what we did see with the first round in the PPP program as well.
Oh, absolutely. I think most people would agree with that sentiment. Lindsay, great to catch up. Lindsay Piegza there of Stifel. Tom, I think we do have to reflect, though, on where we were before this pandemic. Where we were, many people used to come on this program. I won't name them because it's unfair, but they did. They came on this program and they said that we were on an unsustainable trajectory and that the next time we got in trouble, that this deficit would be a problem. And what happened in the Treasury market? What happened in the Treasury market is what always happened in the Treasury market. Right. Treasuries, when they see trouble, rally. And yields came in, and it allowed the Treasury to act counter-cyclically. That's what happened, and many people questioned whether it would. And what are we doing once again? Questioning, once again, the same thing we questioned before the pandemic.
I'm going to give a massive shout-out here to Paul Krugman, the laureate, who has relentlessly stated, John, what you just said, that when you get panic, price up, yield down. And it's, whatever the reasons, whatever the backstory is, that's what you've seen. John, our Twitter account is firing right up right now. Mohammed emails in, I think from the United Kingdom. He points out my grievous error of saying that the Mets are terrible, that they're terrible. And we need to bring up the fact here that the Mets are grossly outperforming the Boston Red Sox. John, it's so bad the Red Sox may get relegated. I mean, this...
Well, it depends what your benchmark is, doesn't it, Tom?
Yes.
I don't know if the Red Sox are a good benchmark right now.
Last
Can
in
you
the
get
American
relegation?
League.
You can't get relegation.
They may get relegated down to Double-A ball the way they're playing right now. I mean,
who would you promote if you could, Tom?
Oh, the Rochester Red Wings, no question about it. But
the Rochester Red Wings. Okay. Shall I get a market check? Shall I get to business?
Yeah, let's do that.
Your equity market with a lift. Lisa's itching to see some prices on the screen. The S&P 500 positive, talk of a stimulus program down in Washington, D.C., and huge confusion about where this economy is, Lisa.
Yeah, well, and that's the key question. You talked earlier about the UK unemployment rate being the most fictitious number out there because of these furlough replacement payments. I'm trying to understand whether this will be looked at in the realm of history as better than the approach that the U.S. took or worse. And there's really a big debate about that, John.
Just about how you classify them. I think for the people on the ground experiencing it, the statistics don't mean a lot.
They don't mean
it's what they feel.
Yeah.
And what they feel right now in the United States and the UK, same anxiety.
I'm going to give you a micro.
Same thing.
John, I'm going to give you a micro. The Mermaid, great restaurant, 3 restaurants. They shut down the 2nd Avenue location. That's all you need to know.
Depressing. Yields up by a basis point or 2 ahead of a Fed decision 24 hours away. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. President Trump will preside today over the signing of historic diplomatic deals between Israel and the 2 Gulf Arab states. The president and his allies hope it will give him a boost ahead of the election. The leaders of Israel, Bahrain and the United Arab Emirates will sign the agreements at the White House. The West Coast wildfires have now become a campaign issue. President Trump and California state officials sparred over whether climate change is contributing to the blazes. The president insists that poor forest management is the culprit. Democratic candidate Joe Biden called the president a climate arsonist and warned against giving him 4 more years in office. Meanwhile, the Trump campaign says it has ramped up television ad spending by about 50%. The new round of ads will focus on the economy, and they'll run for the most part in the battleground states where President Trump is in a tight race with Joe Biden. And the economic recovery in China sped up last month. Retail sales rose 0.5% from a year earlier. That's the first increase since the coronavirus hit early in the year. Meanwhile, China's industrial production rose for the first time in 2020. In baseball, billionaire investor Steve Cohen has a deal to buy the New York Mets. Cohen reached an agreement with the firm backed by the team's owners, the Wilpon and Katz families. Terms of the deal weren't disclosed. The website Sportico previously reported that Cohen's offer valued the team at $2.4 billion. He already was a minority investor. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Is that your view? You don't need all the people you have, or you may not need them all in the office?
We believe that when people are together, that's a critical element for innovation. So we do look forward to having people back in the office.
A sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
ever return to what it was, at least is my perception at this point, sitting here in September of 2020. I mean, I'm not smart enough to, prognosticate where we're going to be in a year and a half.
Mark Shafir there, Citigroup Global Head of M&A. I think we're all trying to work out where we've been and where we're heading and what returns from New York and London this morning. Good morning to you all. Alongside Tom Keene and Lisa Abramowicz, you can hear Tom clearing his throat, as always. In a market this morning, equities pushing higher, and the S&P 500 up by 0.8%. I know you do, and the bond market up 0.68% is your yield on a 10-year. And in the FX market, euro-dollar, 119, Tom, up about 0.25% on that currency pair. Bit of dollar weakness out there this morning through G10.
Well, let's pause quickly here, though, and let's look at renminbi. Stronger 2-3 days in a row. And I mean, come on, it's a managed strength in China. There's no question about that.
Well, let's say how it is, Tom. They're tolerating that strength. The economic data is improving. What I find really interesting in G10, and we touched on this a little bit earlier in the week with Macquarie and Terry Wiseman, not about rate differentials so much anymore. Guy Johnson and I had this little chat yesterday, all about political differentials between the United States and Europe, and arguably the politics, away from Brexit, of course, has improved in Europe. The integration on the mainland is looking better off the back of that fiscal agreement in Brussels several months ago. That was the move to 120. It was about the politics, and it wasn't about monetary policy. It wasn't about rates.
Yeah, well, there's a lot of other things that are good as well. One of them is trying to add up on the Bloomberg terminal the mergers and acquisition excitement that we're seeing, including what we saw on Monday. You get out to 80 billion, 90 billion, you lose count after 100 billion. Robert Perfusek is with Jones Day. He's head of mergers and acquisitions, but that barely describes his many decades experience in all different shades of M&A. We're thrilled he could join us again. Bob, it's been way, way, way too long since you've been on. What's different this time around in the many billions of the M&A derby?
Well, the biggest difference, I think, is obviously the markets have been fabulous in many respects. Everybody focuses on the equity capital markets, but the debt markets are just mind-blowingly supportive. Now, others on your show always talk about how that supports the equity markets too, but it really is a great boon for M&A. And if you stand back over those decades, M&A generally tracks what the equity markets do, and I think we're starting to see that. Now, a lot of people say, well, yesterday is a one-off thing. TikTok is political, not an economic event. The SoftBank deal, it was kind of a forced sale because of other issues that the SoftBank has. Well, yeah, that's true, but there was a lot of other stuff. All the headline deals got, of course, the headlines, but there were many other deals that were announced, including a deal for Verizon, the New York Mets. There are all sorts of stuff. So it's much more active, no question about it.
Well, that's great. Are we at the point, Robert Perfusek, where we're seeing transactions so the other guy doesn't get the company, like Steve Cohen goes out and takes the Mets so Alarian can't buy him? I mean, are we at that point across all of M&A?
Well, yes. We're at M&A is strategic right now. There's a lot of financial transactions. In fact, I at least in my personal world, it started to pick up again in August with some private equity deals, but it's mostly strategic. I don't think that this deal probably was not even mentioned yesterday, the Verizon deal. And that's not a huge deal, at least by comparison to the others, but it was almost $7 billion. And it's designed to build out a part of the Horizon's platform they don't have, the prepaid phone.
Robert,
prepaid cards.
For sure, there are a lot of deals that are strategic and looking to buy revenue at a time of meager growth. But things have gotten a lot more political, and I'm wondering how much TikTok is representative of the increasingly politicized M&A backdrop versus a sort of idiosyncratic affair.
There's no question that nationalism is a factor. You wouldn't have said this, before the current administration, but it isn't just the U.S. And nationalism is a real issue in terms of cross-border deals. No question about it. And how we deal with this stuff going forward could have an impact. Whenever a significant cross-border transaction shows up in the boardroom, you got a lot of directors kind of saying, "Oh, gee, do we really want to go through this?" Because it is a factor. The TikTok deal is unique, but this is a real issue with cross-border deals, which of course is most deals have some element of that.
But Bob, it may well push bigger companies to get with bigger companies. Now, I know there's been regulatory issues, antitrust issues down in Washington, D.C. around big tech, but let's think about how this story is evolving. In Europe, there's a huge conversation about whether they should move away and move towards from this national champions to European champions that can compete with China and compete with heavyweights in the United States as well. And I wonder if that's something that grips the United States to push forward and allow the big to get bigger through acquisition so they can compete with Chinese companies. Bob, how are you thinking about that at the moment?
That's an interesting topic for frankly, kind of a law school debate. I don't think that has more traction in the EU because the EU, obviously, is the EU. It thinks about things in that way. And there's been rumors again recently about UBS and Credit Suisse, and obviously that would raise regulatory and other issues, but maybe that would be something that would fall into that kind of category. The U.S. is different. Politics plays a role, and when the president says something about a deal, the staff people who deal with these things think about it, but it really works out in a much more granular, technical way in the U.S. It's done by people who are largely apolitical. I know that's hard to believe in today's world, but these are in many cases career staff people who are trying to do the right thing rather than follow the political winds.
I'm just wondering how quickly that changes. Bob, it's great to catch up with you, as always. Robert Profusek there, Jones Day, Head of Mergers and Acquisitions. Lisa, that's why I think your question is so important. We go back a number of weeks now where we had those tech hearings on Capitol Hill. It was the Facebook argument from Mark Zuckerberg. We need to be big because we need to compete with China. And if you want our values to dominate, then allow us to be as large as we are. And what happened a week later, Microsoft in the running to buy TikTok. Now, I know that story's changed, but that's the argument from big tech. Allow us to compete with China. Don't break us down.
And to push back on some of the regulatory actions that had been sweeping in Congress, I think it's a really good point. And I think it's great that Bob brought up the UBS Credit Suisse point, because that very much is, to your point, an example of how perhaps the Swiss regulators will allow the two behemoths to get together to be more solvent. I do think it's a different story, though, in the U.S. with some antitrust concerns still on the forefront.
Agreed. But did you ever think, Tom, we'd be talking about UBS and Credit Suisse after what we've just been through in the last few months, that we'd be sat here going into October?
John, I have walked down the Bahnhof in Zurich, and you just wonder, does Switzerland need those two big banks, or should they just effortlessly merge? I mean, you tell me.
I'm smiling, don't you? Because I've walked down there with you late at night.
Oh,
do you remember that?
I don't remember it. I didn't fall in the lake. That's what I remember.
Kama donda kunaweza kaa na mvi ama huyo mvi akatae nikae na yeye juu. Naona kila mtu anaogopa kukaa na ule msee mwingine, anaweza fikiria uko nayo, so bado distance. Lazima nibakishe kiti yangu kama mvi na kaa peke yangu. before nianze wera, before nianze kazi, lazima ni hizo chuma za ndani zote, lazima niziguze na kitambaa na sanitizer. Mask lazima ukuwe na kila time. Juu kama hakuna customer anaweza ingia kwa gari.
We've tried to sanitize people, we scan the temperature as the passengers board the vehicles. But the challenge comes here when some passengers ignore, they don't accept, they don't wear the mask, so that's been a challenge. We used to carry a capacity of 32 passengers, but for now it's reduced to 15 passengers according to distance, social distancing, and this has caused us loss, because the passengers too are suffering because of the fare charge that we have a little bit increased.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Style of value that we know is dead.
The longer term is not looking good right now in terms of the support for consumption.
A lot of the stuff that is priced cheaply right now is a structurally impaired sector that was probably impaired before the crisis and looks even worse now.
Dollar is weakening. Rest of the world is recovering faster.
Bond investors are sleeping on a dynamite pillow, and that dynamite is inflation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast, Bloomberg Radio. Good morning across the smoky nation. Just coming in, Lisa, the images of the sunset you and I observed last night. John Farrow, you cannot imagine the change across this America. Forget about economics, finance, and investment. It looks like Mandalorian out there, Lisa.
Yeah, it's been really depressing to watch that orange sky over on the west, and you're seeing the smoke come toward us. It's a political smoke as well, and I think that is telling, Tom, that everything becomes that much more political in this year of 2020 as we head toward November.
John, you nailed it on the United Kingdom earlier, and the fictitious nature of our unemployment rate. We've got the Fed meeting tomorrow, and I'm sorry, John, the backdrop here, I'm just going to summarize it, is double-digit unemployment.
Unemployment here in the UK, Tom, just north of 4%. Officially, that statistic means nothing to anybody living in the UK right now. There is a furlough program tying a lot of people to the government. That furlough program expires at the end of next month. A huge conversation about whether to extend it. If it doesn't get extended, Tom, just assume unemployment goes higher, much, much higher very quickly.
The news flow extraordinary, folks, just as we saw yesterday as well. Eric Wasson of Bloomberg News out with that moderate stimulus of $1.5 trillion. Unlikely it'll move forward, but nevertheless, there it is. Many other stories as well. John, I want to get to this quickly so we can get to our good guest, Jeffrey. John, what is a market item you see this morning?
Dollar weakness against the bulk of G10, Tom, and G10's got really interesting in the last couple of weeks. Sterling breaking down, Euro breaking out, even as the ECB tries to step back in. And the politics of the moment gripping foreign exchange as well, particularly the US dollar, Tom. That's new. We haven't seen that for a long, long time, and that's the story. in FX for me.
And with renminbi stronger this morning as well. Turkish lira was at a 7.49, really buttressed up against a 7.50, one of the idiosyncratic items out there. He is one of our most popular guests. Jeffrey Yu, like many, synthesizes across all markets. But John, what I love about Jeff Yu is the acuity here, the precision of how he looks at the here and now.
I love Jeff, and he's with us now. Jeff Yu of BNY Mellon, the senior EMEA market strategist. Jeff, let's just touch on foreign exchange briefly with you. The degree to which politics is shaping some of the forecasts right now, how do you interpret some of those things?
You really are seeing it, for starters, in sterling, right? So sterling's price action over the last 2 weeks has just been about politics, and investors are really taking the view. Do you think there will be a deal? Is it going to be a stable move and beyond the transition period? If the answer is yes, then you can afford to have a more favourable sterling forecast, and vice versa. Same for the US. Are we going to head into November in a volatile fashion or a less than volatile fashion? But I'll tell you one thing, though, rather than spot rates in options markets, they really are gearing up for a lot more volatility up ahead.
So, Jeff, for a strategist right now, just how difficult is it to make any kind of forecast, any kind of read on an FX market? It's hard enough to read the economics. How do you read the politics?
It really is becoming, binary. I mentioned the EU, UK status, and for the US. So a lot of people are going to, view the US election in binary terms. I think, as always, the answer is going to be somewhere in between. So you need to find the nuance in terms of what terms the UK is going to get towards, and also for the US as well. What policies will both parties enact, over the medium to longer term? Bringing renminbi into here. Will the PBOC, start to jawbone the currency as well? Right? Can you afford to have a strong currency given the state of China's relations with the West, and also a very weak export market? So all of that's coming to the fray. But I do stress, don't forget the fundamentals on the economic side. And for sterling, I think that's something the market's missing right now.
Jeff, on a global basis, that's right where I wanted to go. The idea of where global GDP is, or the partitions of it, where they are. Are you believing in a more of a global slowdown, or could it actually pick up in aggregate as we see in China today?
I am looking at the China fixed asset investment numbers, and I'm thinking, here we go again. Are we going down the route of real estate again? And that has massive implications for the likes of Aussie, for iron ore, for the Chilean peso, because of how the Chinese real estate cycle can actually pick things up. So yes, we can actually start to see a strong divergence. Now, to be clear, Beijing doesn't want a real estate cycle. They've been very, very clear on that, but that's not going to stop the market from trying to price it in.
I look, Jeff, at the bets that have to be made right now. How do you play dollar then, given the huge ambiguity into the end of the year?
So I think you will have, the three segments here. Firstly, dollar against the rest of the G10. Ambiguity, I think, given how the current positioning in the dollar, in US markets, in US tech, how strong that is. International investors may just think, I don't need to put more in there. Maybe the balance is going to flow more towards Europe and the rest. Then you've got China, emerging markets in Asia, which seem to be managing COVID better. They could actually start to outperform. Positioning is favorable as well. Then you have the idiosyncratic names, like you mentioned, Turkish lira, where you probably just want to stay defensive, full stop, keep some dollar longs, keep your volatility hedges.
Jeff, I can tell you, I've read so many notes recently that have said that FX trading is the new bond trading, that bonds have gotten so boring, to John's point, that FX really is the place to hedge against these geopolitical crosswinds that we're talking about. And I wonder, going back to Ben Mandel's point of JP Morgan earlier, he said bonds are not going to provide a hedge against equities declining in the near future. Really now, it's the dollar. Do you agree?
So the dollar is being used as a risk proxy. I agree partially. So if you want to find the risk event, going back to the point about Turkish lira, if you are worried about an EM balance of payments, shakeout in the likes of Turkey or maybe Brazil or other areas, then of course you want to be long dollar, full stop. That is very clear. But on the other hand, if you're worried about US-driven idiosyncratic risk and cognizant, again, of that strong positioning, especially in US equities, then you may want to be short dollar or underweight dollar as a hedge. So if we want to focus on the US, on the election result, then the dollar is actually now the counter hedge. You want to view it the other way. Where international investors put their equity flows next year, that really is going to determine where the dollar is going to go.
So this is the confusion for me, Jeff. If the dollar is considered a hedge against a risk-off feel in markets, are you saying that election turmoil or some sort of disruption to the U.S. economy would be considered a risk-on type of event for the rest of the world? I mean, can you get get that polarity where you have a disruption in the world's biggest economy and people flee the haven currency?
I think you will get that if it's going to be very, very US specific and the and being very crucial here, and you have an alternative. And actually, we think you have two alternatives right now. So firstly, for the euro, for once, they really have gotten their act together with the investment plan, €500 billion to flow over the next 2 years or so. And also with the renminbi, China, clearly the data showing up. So I think what happened 6 months ago in March, people still went back into the dollar because there was no alternative. Everyone was in the same boat managing COVID. But now towards year end, you have an alternative, and that's where the dollar is going to be vulnerable.
Jeff, what I hear from you in the last 8 minutes is that risks are skewed asymmetrically towards more inflows into international equities. Is that a fair characterization?
That certainly is, and I think euro, has the most benefit from that. If I look at Europe right now, I actually see more of a European equity story, rather than a euro story, because we know that inverse relationship between stronger euro and European exporters. The thing is, you have a plan right now to fill that investment gap, which is emerging in Europe. Same in China. When there's investment gap, the state, they will fill it in immediately. In the US, however, because fiscal is not on board, and you have some more, you will have some more political risk heading into year end, the investment gap may not be filled at all, or at least it will take more time. So in that order, I think that's why Europe and China can stand to benefit over the next few months or so. You do have
the story you're describing in the FX channel doesn't sound like a story the ECB can fight, can they?
I don't think the ECB can fight, and again, to repeat what Madame Lagarde said, they do not have an FX target, right? So I think they are making the calculation that this demand gap being filled over the next 2 years will be strong enough to offset, any disinflationary impact from a stronger euro. You saw it in their forecast. Moving the euro forecast up by 10 big figures to 118 had zero impact on their inflation view. That's a ballsy call, by the way, but if they can maintain that, they would be happy for euro to, say, move 10, 15 big figures, every 6 to 12 months or so, because, again, they're not worried about the demand side, but it's going to be careful calibration.
Hey, Jeff, really do enjoy catching up with you. Jeffrey Yu there of BNY Manning. You look well, and that's good to see. Tom Keane, going back a number of years now, I remember at the British Museum, full audience in the auditorium with Jeff Yu on a foreign exchange panel, and Jeff just knocking it out of the park. Just fantastic to hear him talking about foreign exchange.
Well, what's so important, and this goes back to the great Michael Rosenberg at Bloomberg, who's done so much for us, particularly on indexes, folding in financial conditions, is John synthesizing it all in together. And that's especially difficult to do right now with the fiscal impulse that we've seen. I mean, I don't care what the country is, what the foreign, the nation is, what the pair is, synthesizing right now, which is a guy like you does every day, it's really, really difficult to do.
Incredibly complex, but I think it's fair to say, just to identify where the consensus is right now, just in terms of the risk factors on the horizon, Tom, overwhelmingly the consensus is the United States is the big risk factor at the moment. Even with this Brexit mess in the UK and across Europe, it seems to be the US that many people identify.
Absolutely, and that call, when you look at the dominance of U.S. equities or selected equities, it's really been a wrong call. But I totally take your point, John. Right now, there's a real effort here to get back to international in some flavor.
Politics, Lisa. You heard it from John Norman of JP Morgan in the last 24 hours, held hostage to U.S. politics. The outlook. And for many people, they agree with John, Lisa.
Yeah, although I will say the one area that seems a little divorced from politics today is the Chinese yuan. And I'm glad that Tom keeps bringing it up, but it is the strongest versus the dollar, the offshore, since 2019. I think this is an interesting story as you continue to see the data recover over in that country.
Say it, Lisa. Let me tell you something.
Oh,
foreign exchange in that Chinese currency.
Yeah,
go on. Right now.
I did not say it.
We should have a banner
on the S&P.
He's giving that into
we advanced 26. I think we've got that banner made.
We have that
banner
for our chiseled out
radio.
in granite.
Don't worry. It's going to be repeated.
Oh, I know
repeatedly.
It will. Oh, I know.
In the year to come.
Let me tell
Coming up on this program, Colin Whitmer, PwC deals leader. Looking forward to that conversation. Up shortly, right here on Bloomberg Surveillance.
We
With the First Word News, I'm Ritika Gupta. On Capitol Hill, it's a long-shot attempt to break the deadlock over another coronavirus relief bill. A 50-member group of House Democrats and Republicans will unveil a $1.5 trillion stimulus package today. Its offers comprises on the two thorniest issues, aid to state and local governments and supplemental unemployment insurance. Hurricane Sally slowed slightly overnight in the Gulf of Mexico. It's now been downgraded to a Category 1 hurricane with winds of 85 miles an hour. Sally will make landfall tonight or early tomorrow, but exactly where it is difficult to say. Hurricane warnings extend from New Orleans to the Florida Panhandle. There are fears that the hurricane will bring a deadly storm surge and flooding. And the economic recovery in China sped up last month. Retail sales rose 0.5% from a year earlier. That's the first increase since the coronavirus hit earlier in the year. Meanwhile, China's industrial production rose for the first time in 2020. And in the UK, Prime Minister Boris Johnson's law-breaking Brexit bill has cleared its first hurdle in the House of Commons. Johnson plans to renege on part of the divorce deal. It's a move that has been denounced by members of his own Conservative Party. They warned it could damage the UK's reputation. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I think what we're seeing during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I wouldn't say we're interdependent. We benefit from each other in terms of, the U.S. sells jet engines and entertainment, and we used to want to sell, expensive chips that would create high-paying jobs. And so I think you have to really decide where is there still mutual benefit.
Bill Gates on the relationship between the United States and China. Fascinating conversation. Find it in full on Bloomberg.com and on the Bloomberg terminal. An hour and 12 minutes away from the opening bell. Here's the price action in equities. We have a lift. Session highs on the S&P 500 up 26. We advance 0.75%. Talked about it through the morning. I'll touch on it again in G10. The dollar weaker against absolutely everything. Euro dollar up 0.25%. Sterling advancing 0.5. The Aussie dollar up 0.6%. Gives you that feel of risk on this Tuesday morning. In the bond market, yields just a little bit higher, Tom. Up a basis point on 10s, up 2s on 30s. The Fed decision coming up tomorrow.
Very good. And, John, I'd also note the VIX in with a 25 handle. A 24 print would be something. We do have a lower VIX with the elevated futures. 25.33 on the VIX right now. There is an M&A frenzy. We heard Robert Perfusek at Jones Day moments ago. We can talk to everyone across the Bloomberg intelligence landscape as well. And then you got to do something about it. Colin Whitmer is in charge of that. You got to do something about it with PricewaterhouseCoopers, PwC, and he is their transactions, their deals leader. Colin, thank you so much for joining us. Define the new synergy. I want you to define the ballet where two come together, they mate. There's a certitude about the cost reductions we're going to see. Are they the same now as they were 5 years ago, or is there a new synergy?
Just thinking about what you're talking about there, Tom, think of it this way. Look, deal makers got to get deals done, right? And we have a really unusual environment where equities have performed really well during a period of tremendous uncertainty. So buyers and sellers, for starters, got to bridge the gap. Your private markets will look to your public markets for multiple guidance on deals. But I just think there's right now a disconnect out there between buyers and sellers that needs to be bridged. And what we're seeing is a trend in things such as contingent purchase price and earnouts to help bridge that gap between buyer and seller and sort of get over that divide of uncertainty.
We're seeing, though, a very large number of billion-dollar transactions, as Bob Perfusek said, from Verizon, 6-7 billion, all the way up to the mega deals as well. How will those deals come together? And are you, with the expertise of PwC, certain that they can get synergistic benefit?
Yep, and it's going to be more challenging, certainly, in this virtual world, in the virtual environment. And we did an M&A survey recently, and you think about certainly synergies, but what a lot of deal makers are thinking about is talent and culture. And when you're putting two large companies together like you just described, and now with the trend of virtual working, how is one company that's going to allow a work-at-home culture and another company that's going to be a work-in-the-office culture, how is that going to come together? And how are you going to retain that talent? So I know a lot of deal makers have on front and center of their mind is, yes, we got to drive cost out of this business, but how do we make sure we keep all the talent we have? Employees tend to also be motivated by different things now, very much their ability to work at home, flexibility. So all of that hasn't necessarily been on front and center for deal makers' minds, but it is now.
Colin, to John's point earlier about antitrust concerns, do you feel like those have diminished in this era of COVID as regulators just want to see some of these companies survive, let alone get concerned about behemoths getting that much bigger?
Yeah, and that's an interesting question. I mean, to just think about cross-border deals in general, they had been coming down for a while before the pandemic. The wave of nationalism had started long before that, and many of the countries out there had already started to revise their cross-border investment approvals. So cross-border deals, I think, are still going to be down. And I think when I do see them get done, they get done for a couple of reasons. One, they want to diversify their revenue base. But secondly, even more importantly, is their supply chains. They take a look at their supply chains and say, do I really want to be operating in say, China, for example, or do I want to disperse my supply chain and get closer to my customer, or be in a more regulatory friendly environment. So I think you'll see some cross-border deals get done just to reshape the supply chain to get in line with their new sector normals post-COVID.
I guess another way of looking at this is, are you seeing more smaller tech companies combining forces in order to survive against the Amazons and the Apples and the Microsofts of the world?
Yeah, you'll see a lot of smaller tuck-in and absorption deals for people to sort of stay current and stay at pace with the market. I think that's exactly right.
I mean, Colin, the turmoil right now, we're in a pandemic. Someone, you know, the gloom crew like Lisa would say, we're sort of on the edge of early depression and all that.
Really?
And yet, yeah, really. But we have this M&A frenzy going on. From where you sit, is it a frenzy?
I would just say this, there is so much capital out there, right? There's a significant amount of capital that needs to be put to work. So when you think of it that way, it's no surprise that there's money out there chasing deals. The other thing I'd say is people are using the pandemic to accelerate their digital transformation. So if one good thing maybe had come out of this, it really has pulled forward companies' digital agenda to transform. And they, like I just said before, they need to transform to their new sector normal. So the way they did business in the past may not be the most efficient way or even a relevant way to do business in the future.
Yeah.
And the quickest way to right that ship is M&A. And with the amount of capital out there, you put all that together, we firmly believe that M&A will recover faster than the overall economy.
Colin, just quickly here to touch on the biggest M&A story probably of the week, that would be Oracle not buying TikTok's U.S. operations, but managing the data in its cloud. That, according to details reported by the Financial Times and the Wall Street Journal. How should we view this particular deal?
You know, I can't comment on that deal specifically, but as I think about transactions of that type, I mean, not everything will have to be a straight-out acquisition, right? I think we might see more partnerships and more strategic alliances to help bridge things like you're describing there. How can I deal with my data concerns that doesn't necessarily manifest in a transaction, but some other form of partnership in order to, you know, to secure the data.
Hey, Colin, great to catch up. Colin Whitman there, PwC deals leader. Tom said this yesterday, just feels China-esque to see some of these partnership deals being announced in America. Not happened yet, let's be clear about that, but the prospect of Oracle doing what it's proposing to do with TikTok, it's the kind of thing you'd expect to see from China, a partner for access.
Yes, I read like 7 articles on this, John, in the last 24 hours, and what I find incredibly important is the argument of 3 days ago about the algorithm. It's just disappeared from the dialogue. This is nothing more. I don't have an opinion on it, but it's nothing more than 3 and 4 and 5 parties trying to manage, not a train wreck, but manage a process forward.
Did you read the Abramowitz column on Zero Hedge last night on this particular issue, Tom?
No,
I missed that one too.
Now.
Yeah? What did it say?
He's a guest writer now.
Oh.
I imagine you do well over there, Lisa. I mean, I like Zero Hedge.
You're trying to pawn me off to Zero Hedge. You're literally trying to pawn me off on live television.
No, I just think they sound like your kind of crowd. I think you'd all get along.
I like identifying
Tyler
points
Durden
of potential
and
problems.
Abramowitz together. I agree with you. I'm winding you up. And I love Zero Hedge too. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Coming up, Paul Donovan, UBS Global Chief Economist. Live from a beautiful London. You love it when I do this.
Stay
Just
there.
Take it in. Just take it in.
way we work and live has been interrupted. Uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
From New York City and London for our audience worldwide, good morning to you all. 1 hour away from the opening bell, your price action shaping up as follows this Tuesday morning. Equities advancing, going into that two-day Fed meeting, concluding tomorrow with a news conference with Chairman Powell. In the bond market, 0.68% is your yield on a 10-year, up a single basis point, just about up a couple on a 30-year. And the FX market talked about it through this morning. Euro strength, dollar weakness, I get my words out. Euro dollar just south of 119, up 0.2% on that currency pair, and just short of 3,400. Tom Keene on the S&P 500 futures, up 26. We advanced 0.75%.
A little bit of a pop there and yields higher there. The Empire Manufacturing comes in, John, and it is a much better statistic. I'm going to call it a secondary statistic. This out of Buffalo, New York, the New York State Empire Manufacturing statistic. But, John, nevertheless, 6.9 was a survey, comes in at 17. That is not a bad statistic.
Previous read 3.7, upside surprise. And Tom Keene, how many upside surprises have we seen in this economy over the last several months? Hanging in there, improving. Getting a read on this economy, though, still super complex and very difficult.
Well, let's try to do that right now. Paul Donovan joins us with UBS, their global chief economist, and just a wonderful perspective on the Pacific Rim. The upside surprise, Paul Donovan, has been China. I want to go back to the UBS heritage of Jonathan Anderson from years ago in the UBS expertise. I don't want to know about Hong Kong or Shanghai or Beijing, Paul Donovan. What does UBS see in the rest of China we never speak of?
So the Chinese economy, we saw this morning with the industrial production data, production is kicking back in. China is a very interesting comparison to what we're seeing in the US and in Europe. Because in the US and Europe, what's happened is consumers saved money during lockdown. And then as lockdowns have ended, they've started to spend it because that's what consumers do. But in China, the consumer was less able to save money. So the domestic economy was sort of a little bit on a back foot as it came out of lockdown. Unless you were middle class, you didn't really have savings to spend. But what's now happening, of course, is that we're seeing global consumer demand picking up. And that's working its way up the supply chains. And we're seeing these better production numbers coming out of China, beating expectations. I don't have a lot of faith that the expectation is particularly accurate. The range of forecasts is very wide, but certainly a decent number coming out reflecting that improvement in global activity.
Okay, you can extrapolate it to Australia, and John Farrow's mortgaged the house long Australia here into the end of the year. Can you extrapolate it to the rest of the world? Can you extrapolate Chinese better over to America and over to the continent of Europe?
I think it has to be taken looking at both sides. So China is a link in global supply chains. It's now the world's largest manufacturer. It's a key part of global supply chains. So if we're seeing better production in China, if we're seeing improvements in the export numbers, that is telling us something about global levels of demand. And we're seeing it also come through in terms of proper indications about confidence in the economy. Not these useless surveys, but detailed behavior of consumers, of individuals in Europe and the US is pointing towards a better economic outlook. And this is always the case. markets are always too pessimistic about recovery from a crisis. This was no different to previous crises. The markets have failed to understand the speed of the bounce back, the resilience of consumers and businesses in the face of a challenge.
Paul, is there anything unique about the willingness of many people to still underappreciate this rebound in this economy?
So I think we've got some complications here. So we've got problems with the data itself. I mean, the data quality has been deteriorating for several years, but it's been really, really bad during this crisis. And we're now seeing the inconsistencies in the data. So the fact that different countries use different methods to calculate GDP, only economists get excited about this most of the time, but now it's leading to these absolute anomalies in the data when you do international comparisons. So that's throwing up a lot of problems. But also, of course, what's happening throughout all of this is the pandemic has accelerated the structural changes of the fourth industrial revolution and also the environmental credit crunch. Both of those big structural issues have been sped up throughout this. And that means, of course, that we may be failing to capture some of what's going on in the economy. So to give just one example, we have seen an absolute surge in business creation in America, in the UK, in France, in Japan, in Singapore. Huge increase in business creation since lockdowns ended. That's not likely to be properly reflected in the data. Some of the entrepreneurship is just going to be missed because the statisticians aren't going to be looking for it.
So do you think that right now going forward, we're going to see ongoing improvement in the data, or do you think that with the pullback in fiscal support, we'll see a plateauing? I mean, do you think that right now people are still getting it wrong and expecting a cool down in the recovery?
So there will be a cool down. I mean, let's be realistic. What's really fueling this is the fact that most people accumulated about a month's worth of income in savings whilst they were stuck in lockdown, unable to do anything. And of course, as soon as lockdown ends, you've just spent, whatever it is, 2 months stuck at home with your close family as companions. You're desperate to get out and get away from them, and they go out and spend money. And that's what's happening. And that's the surge of the third quarter. Now, that's not going to last. It's like a tax rebate. Within 6 months, this money is going to be gone, and we're then back into a more normal pattern of growth. But I think that will still be fairly resilient because the labour market is bouncing back more strongly, and we do get fiscal support, particularly in Europe, obviously, but also potentially in the States next year. The other thing to remember is, of course, that we've been seeing an awful lot of upward revisions to numbers. So once business got a bit back to normal, we saw statisticians being able to go out and collect data a bit more reliably. And so in both Europe and in the United States, there's been a lot of upward revisions. Sort of the revision index, which looks at revising data, has been ticking up since lockdown ended. And that's also telling us that actually things weren't quite as bad as we thought in the second quarter.
The other aspect of this, and you wrote an essay on this that I thought was fascinating, was that you believe home working actually boosts growth. Can you talk a little bit about that, especially if that growth may not be in the big cities that traditionally were the economic engines?
So I think the first point about this is this was going to be happening anyway. The technological changes, the changes of the fourth industrial revolution, fascinating from an economic point of view, in many ways reverses the social shifts of the first industrial revolution. We're leaving the cities and going back to rural areas or out of town. But what that does, of course, is it changes patterns, it changes work time. So I'm not traveling to work on London Underground, spending half an hour to and from work every day stuck on the Central Line. My daily commute, if I'm working here from home, is me stumbling 5 yards from my bedroom to my home office. That's it. So I'm saving myself an hour a day. And what am I doing with that? Well, I'm looking for entertainment. I'm looking for leisure. And I may spend money in doing that. And this, of course, is been the progression throughout the 20th century. Lord Keynes very famously wrote that we'd all be working 15-hour days by the year 2030. I'm sure that's true for Tom, but your average economist is not working a 15-hour day. We're really having to push the hours in. So Keynes was looking at this big drop in terms of the amount of time that people were spending at work, and it happened. But it happened because we spent less time doing chores outside of work, less time doing housework, less time commuting, and we had more leisure. That's what's going to come out of this, I think. Home working is not something to be shunned. It changes the structure of the economy, but it changes it in a good way, which gives people more free time, and it gives them the opportunity to spend money in different ways and to raise their standard of living.
You know, John, it's just amazing that Paul Donovan in this pandemic has graduated from the Muhammad Al-Arian Pile-on Tom School.
He sees right through you.
He's summa cum laude.
He knows. 15-hour week, pretending he does a 70. Just tell everyone. Go on, go.
You want me to go? Okay, I'll go. Paul Donovan, what's so important here in the time we're in, and there's such a respect for the holistic nature of your research reports. What do we need to focus on global trade? I mean, Stiglitz talks about the globalization and our discontent and all that. What's the thing forward on world trade we need to focus on?
So, globalization, the rise of global trade as a share of GDP, that's over. That's done. Because the globalization story of the last 25 years was about increasingly complex, increasingly long supply chains, and that's no longer desirable. And again, this is a change. It's not being brought about by the pandemic. It's being accelerated by the pandemic. And we're now, I think, going to see a fairly steady decline in global trade as a share of GDP. But there are two possible ways this happened, and they have very, very different implications. If we go down the route of trade taxes, tariffs, that is not good news, because that is telling companies, right, you've chosen the best possible location for your production. We're going to force you to go to somewhere that's second best. No company wants to go to second best. That's less efficient. That's going to lead to either squeezed profits or higher prices for the consumer or some combination. But if we see automation, robotics, digitization coming in, then what that is going to be doing is leading to localization of production. You start producing close to the consumer because it is efficient to do so. And that's going to be a very, very different situation, because that means lower prices for the consumer or higher profits for the producer or some combination of the two. So what we've got to focus on is, look, globalization, as we've recorded it, it's going into reverse. There is a negative story around trade taxes and autarky and all that sort of stuff. But there's also a positive story about it's just more efficient to be producing closer to the consumer because of the technological changes. And so working out which of those two options is predominant, that's going to be key.
The shortest 9-minute interview we've ever done. Paul, it just went too quickly. We've got to do it much, much longer next time. Paul Donovan, great to catch up. UBS Global Chief Economist. Love these conversations, Tom. Always step away, think about them, and learn a lot along the way.
Well, you got to do both. You know, that when we started surveillance years ago, John, I mean, it's what it's about. You got to do the narrow, the micro analysis, and you got to do legit macro. But the thing, John, you got to do that Donovan does so well is you got to combine them together into a microeconomic rigor. Very few can do that.
Here's the price action right now. Upside surprise on Empire Manufacturing, session highs on the equity market. Your S&P 500 up 31. We advanced 0.9%. Coming up, good friend of this program, Barry Ritholtz of Ritholtz Wealth Management and Bloomberg opinion columnist. That's next on Bloomberg.
With the First Word News, I'm Ritika Gupta. President Trump will preside today over the signing of historic diplomatic deals between Israel and 2 Gulf Arab states. The president and his allies hope it will give him a boost ahead of the election. The leaders of Israel, Bahrain, and the United Arab Emirates will sign the agreements at the White House. The West Coast wildfires have now become a campaign issue. President Trump and California state officials sparred over whether climate change is contributing to the blazes. The president insists that poor forest management is the culprit. Democratic candidate Joe Biden called the president a climate arsonist and warned against giving him 4 more years in office. And the Trump campaign says it has ramped up television ad spending by about 50%. The new round of ads will focus on the economy, and they'll run for the most part in the battleground states where President Trump is in a tight race with Joe Biden. And in baseball, billionaire investor Steve Cohen has a deal to buy the New York Mets. Cohen reached an agreement with the firm backed by the team's owners, the Wilpon and Katz families. Terms of the deal weren't disclosed. The website Sportico previously reported that Cohen's offer valued the team at $2.4 billion. He already was a minority investor. The economic recovery in China sped up last month. Retail sales rose 0.5% from a year earlier. That's the first increase since the coronavirus hit early in the year. Meanwhile, China's industrial production rose for the first time in 2020. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We never thought COVID-19 is going to hit us, but now looking back, I don't know how we could cope without this new sector.
Hong Kong is not by itself a big market, but because of the growth GBA, there's huge opportunity. So we're seeing a huge wave of biotech innovation coming in the past few years.
Almost kind of certain that at the very beginning of our journey to pursue the biotech listings, we'll see a lot of the Chinese companies.
This is just the right thing to do at the right time, and it's such a big sector.
We have a second product for approval, and now are actively preparing for the commercialization. And we're expecting to have 2 more products to be approval before end of the year. So we have a high confidence that we will meet the expectation.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Is that your view? You don't need all the people you have, or you may not need them all in the office?
We believe that when people are together, that's a critical element for innovation. So we do look forward to having people back in the office.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We have an asset bubble because interest rates are near zero and negative in many parts of the world, and that, at least to my way of thinking, through dividend discount models and so on, have inflated growth stocks.
Bill Gross, PIMCO co-founder on this market. Really interesting conversation. Find it on Bloomberg.com and on the Bloomberg terminal. Tom Keene, looking forward to catching up a little bit later with Priya Misra of TD Securities. We'll do that at the top of the hour on Bloomberg TV. And then, Tom, I'm going to get out there into the beautiful sunshine in the beautiful city of London. And I'm going to have a nice cold pint. Just have a nice cold pint.
Yeah,
and then I'm going to send you a photo of it.
I got the spiky things on like at Davos to trip on the ice here in New York, John. That's good to know as well. John, seriously, what we're going to do is be considering the New York Mets. We'll get to that here in a moment. We welcome all of you on Bloomberg Radio, Bloomberg Television, and we can always go like 8 different ways, Lisa Bramowitz and myself, with Barry Ritholtz. But right now we're going to look at something that I am absolutely baffled by. My job is to keep my opinion out of this. I fail at that every day. Barry can be a little more opinionated. Of course, Masters in Business is a definitive podcast working with Ritholtz Wealth Management as well. Barry, let's begin with a simple question. Do you own Oracle? Do you own the types like Cisco?
Well, the only way we own it is through large index ownership, but we don't own the stock individually, which is probably a good thing because who knows what's going to happen with this.
What I find, Barry, so interesting here, and I think a lot of people don't know this, there's the performance of tech, and then there's a single-digit shareholder return of the infrastructure guys like Cisco and Oracle and them as well. And Mr. Ellison is desperate to get in the game with these other guys. That's really hard to do.
It is, and you can build it or you can buy it. The problem is that Oracle is doing neither. They're not building their way into the newest, latest, greatest technology like social, and unfortunately, they ain't buying anything.
Okay, let's take a step back for a second. For people who are not completely up to speed, Oracle is said to be the winning bidder for a transaction that has not been approved yet to basically safeguard the U.S. data of TikTok, the social media site run by the Chinese-owned ByteDance. And this is sort of a very controversial move. One way to look at this, though, is that Oracle is going to beef up its reputation as a cloud computing giant, giving it a chance to compete with Amazon and Microsoft. If that's the case, isn't this a good thing, Barry?
Well, let me challenge the fundamental premise of your statement. TikTok is not for sale. All the headlines you've been reading about the negotiating process and the mergers and this has been for sale. It's never been for sale. This whole thing has been a giant feint by the Chinese government. And the reason we know this is because of Microsoft's withdrawal from the bidding process, because the value in TikTok is its underlying algorithm, which the Chinese government is not allowed to be transferred to the U.S. So what are you buying? You're essentially buying, it's like you're buying Google just without the search.
Well, no, Barry, this is important, folks, and this is 7 paragraphs down, folks, where nobody reads it. The only thing you're buying, I believe, is the collection of the American data to reside in America on Oracle machinery and Oracle hardware. Other than that, Barry, I don't really understand what they do.
So go back, let's step back a sec. Part of the reason why this White House stumbled onto a correct decision almost by accident was because of the actual security threat that's created by allowing the Chinese government, communist government, to have so much data about so many people in America through TikTok. There are no privacy laws. There are no you own your data as in Europe. Basically, TikTok has access to a lot of things that most privacy advocates believe should not only not be available to the companies, but it certainly shouldn't be available to arguably a frenemy or even a hostile party. It's a very, very effective tool. When you read about how the Chinese have created their own version of the internet and have become just a tremendous surveillance state, this is potentially dangerous stuff in the hands of a foreign adversary. The transaction, as it's been described, does nothing to thwart that potential security threat. And so the concept that somehow this is a sale, but we're going to not include the crown jewels. Oh, and by the way, we're still going to be able to collect the data remotely from China.
Yeah.
This whole thing is just security theater and political nonsense. TikTok is not for sale. The Chinese will never let it be sold. And I got a ton of money betting against anybody who says otherwise.
All right. Well, putting aside the political considerations in TikTok for just a second, taking a look at the biggest merger weekend of the year, do you think that this will be a net good thing for equity prices and potentially more importantly for the U.S. economy?
You know, we go through these long periods of time where we deconglomerate, where we take these big mashups. General Electric is in the middle of spinning out so many different pieces over the past decade. And then we'll go through another period of time where we start putting those conglomerations back together. So I'm kind of neutral on it. It tends to be a later inning in the cycle sort of thing. Corporate executives tend to miss when things are really, really cheap for M&A. Nobody was making acquisitions in 08, 09. Or very few in 10. But now in 18, 19, 20, the acquisitions have ramped up. So there's an opportunity when things are cheap, and execs tend to be a little skittish then. Now you're using your inflated stock to buy other inflated stock. You know, we're in the past, it's been kind of neutral, and there's always someone left holding the bag when the music stops. I'm colored by AOL Time Warner. Those sort of deals. We're not at that level yet, but we're certainly 6th or 7th inning.
Barry, remember that day. Barry Ritholtz, thank you so much on AOL Time Warner. Mr. Ritholtz, of course, with his wonderful podcast as well. Lisa, absolutely extraordinary out there. And going into the Fed meeting, I really have to say there's going to be a lot of information on a bond market that's dead in the water. Sometimes that's a good thing in that we may get some real directional tone off the Fed meeting.
Perhaps. The question I have is what kind of guidance are they going to give as to how they're going to increase inflation? How are they going to measure inflation? And I think, Tom, we don't talk enough about this, the sort of divergence in the inflation in day-to-day goods that people buy versus a lack of inflation in other areas that are measured. And how much does this matter to the Fed?
An academic paper just in the last couple of days saying inflation's actually set much, much higher than what the statistics say. That'll be something to speak about here into October. There is a spectacular article today out by Catherine Burton of Bloomberg News on the underperformance of Bridgewater Associates. Ray Dalio's a class act. He will appear on Bloomberg this afternoon with our Eric Schatzker. Can't say enough about the importance of that interview. Futures advance up 30. Stay with us. This is Bloomberg Radio. This is Bloomberg Television.
sometimes you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
The cybersecurity sector obviously is no secret that it's probably going to do very well in the next 5 to 10 years, say.
2020 is already surpassed previous years' funding in digital health in particular.
I personally prefer to buy businesses that make money, and if you can buy them that are unlevered, that just means they're even cheaper.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
From London and New York, for our audience worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes until the opening bell this morning. Good morning to you all. Equity futures punching through 3,400 on the S&P. We advance almost 0.9%. We begin with the big issue. We're told the outlook is held hostage by U.S. politics.
Political risk rising.
The risk of obviously this sort of fiscal cliff.
Big if and when questions on fiscal stimulus.
We're in for another few months of volatility.
Volatility around the election coming up in the U.S.
The election risk is kind of being redefined right now.
Whether this U.S. election will be a clean election.
We may have a contested election.
A contested or litigated one.
A lot depends on policy.
It's all about fiscal.
Unless we get more support.
We can't even agree on a package.
The U.S. will go back into recession.
The political noise can become more important.
Politics is front and center.
We're unfortunately moving out of the period where there's maximum cushion around the business cycle in order to accommodate some of these political risks.
Let's bring in Kevin Cirilli, shall we? Bloomberg Chief Washington correspondent. And Kevin, we understand, you understand, we all understand that we might have a deal down in D.C. The prospect of one, at the very least, Kevin.
Well, two things. First and foremost, the Problem Solvers Caucus, a bipartisan group of lawmakers, are set to unveil later this morning their proposal. This is a group of 50 moderate members in Congress that they say is going to allow for there to be some type of narrow path to a fiscal stimulus. Now, it's valued at $1.5 trillion as it relates to the unemployment benefits. This would be at $450 per week. This is something that could potentially anger both the far flanks of each party, the Republicans and Democrats, respectively. But again, the details of this being led by Congressman Josh Gottheimer, a Democrat from New Jersey, as well as Congressman Tom Reed, a Republican from New York. Behind the scenes, these discussions have been going on for quite some time. But on the issue of state and local governments, it's $500 billion that are set for state and local governments. And that's really something that is right in the middle, smack dab in the middle, between the proposals from Leader McConnell and Speaker Pelosi. But the second point that I would make here is that Jared Kushner, speaking earlier this morning to reporters, saying that the fiscal stimulus might have to wait until after the November 3rd election.
Kevin, this plan set to be revealed at 11 Eastern, of course. We'll be fixated on that when it is unveiled. But from your reporting so far, your conversations, any pushback? Seemingly, we understand the details of what could be in this bill. I understand that most of Washington, D.C. will as well. Any pushback at all?
Well, you know, I was speaking with an aide, or communicating with an aide on the Problem Solvers Caucus, and they said they're very bullish on this. And they said that if Leader McConnell and Speaker Pelosi are able to peel off some of their members who are entrenched in the far flanks, that they might be able to get to some type of consensus. What things to watch for in the next 48 hours? One, does Speaker Pelosi allow this to come to a vote in the House? Does it get out of the House? And then secondly, would Leader McConnell allow it to get up for a vote? Because if Democrats and Republicans are on board, but the flanks of their party aren't, this would allow for the president to have an opportunity to say that he was moderating on the economy for this fiscal stimulus issue at a time in which politically he needs to make inroads with the suburbs.
Kevin, just in the last week or so, you and I have had a conversation about how political incentives have aligned and lined up for both parties to basically step back from a fiscal effort and blame each other. Are the incentives in the right place?
You know, I think that there remains still incentive based upon the political strategists that I talked to. There remains incentive for many of these more moderate members, Republican and Democrats alike, to deliver some type of deal. You know, whether you're out in suburban Phoenix or suburban Philadelphia, there does remain that opportunity for Democrats and Republicans who are smack dab in the middle and trying to navigate incredibly polarized times when the middle class is really getting whacked as a result of the economic calamity following the pandemic, to say that they were able to get a deal. But again, with the White House commenting, saying that they still might have to wait till after November 3rd, we're still in the fog of this unveil. We should have some more clarity within the next 24 to 48 hours whether or not this is viable.
And we'll catch up with you then. Kevin, great to see you. Kevin's already down in Washington, D.C. there. In this market, 26 minutes away from the opening bell, we are nicely through 3,400. We are up 0.9% on the S&P. We add a little bit of weight back to the market after the sell-off in the last 2 weeks. We are up 30 points on the S&P 500. When we catch up with guests, though, we're told continually it is about the outlook, and that outlook is held hostage by U.S. politics. Eric Stein of Eden Vance weighing in on the impact of the election on the markets. He wrote the following, quote, "The geopolitical ramifications of the U.S. election should not be underestimated and could even be more important than the impacts from a domestic tax and regulatory policy perspective." Eric joins us right now on the phone. Eric, just build on that. It's a little bit more for us, please.
Hey, Jonathan, first off, thanks for having me on, and good morning. Look, I don't want to, poo-poo too much regulatory and tax policy, because I think that matters a lot for the economy, matters a lot for the markets. But in particular for this election, U.S.-China is really the biggest issue facing us, in the U.S. and globally. Obviously, it's the pandemic right now, but if you look out to the next decade and decades in the future, it's really U.S.-China. And I don't think the difference is going to be so much in what we're trying to get, but the approach would be very different in a Trump administration if President Trump gets reelected versus the Biden administration. So I think the U.S.'s place in the world, multilateralism versus unilateralism, that's kind of what's on the ballot on the first Tuesday in November.
It's interesting as we have this conversation, Eric, the first issue that you raise is just getting clarity on policy. When, Eric, I speak to a lot of people at the moment about the election, and their big worry right now is that we won't have a result on November 4th. What's your response to that?
Yeah, so look, that's certainly a concern, not only given how, given the nature of the electoral college system, how close things can be, postal voting, just the way, political temperatures are in this country right now. I think that's certainly a possibility. And if you go back to 2000 and look at the Bush versus Gore contested election, people cite that at markets. I think the S&P sold off something like 7%. Here we are. It's obviously, very different just in terms of times and what's going on with the pandemic and what's going on politically. So certainly, markets don't like uncertainty. I don't think they would like a contested election.
Right now, though, either party, whoever gets in power, Eric, both sides want to stimulate this economy. They will both have different ways of doing that. But at the moment, that's where the consensus is. And if we can get a deal down in Washington, Eric, simple question for you, maybe slightly juvenile. What do you want to be long if that deal happens down in Washington?
If the deal happens, I think you probably want to be, short the U.S. dollar, long commodity currencies, things that are more cyclical. Maybe at some point, stocks rotate back into value versus growth, or EM equities outperform the U.S. Things like that. Trades that people have been waiting to happen for a long time. Who knows if they're ever going to happen? But I think in particular, as I said before, commodity-related currencies. Maybe the yield curve steepens, inflation break-evens, things like that.
Is it your base case that we do get that fiscal deal down in Washington? Is that your underlying assumption and your positioning right now, Eric?
Yeah, I think we'll get some type of deal because, as you said earlier, Jonathan, certainly it's incentives for both parties, to blame each other. But I think it's also an incentive to not let things fall too much off a cliff. If anything, you can argue that the rebound we've seen in the U.S. economy, granted from a very, very low level, and there's still, tons of people who are out of work and suffering. I don't want to minimize that. But as the economy's rebounded, if anything, that puts a little less pressure on politicians to do more fiscal stimulus. If the economy takes another another leg down. If markets take another leg down, I think that will put even more pressure to get something done from a fiscal perspective.
Eric, there is a ton of suffering, and you're right to recognize that, but the suffering depends on where you look. Now, let's just do this on a sector basis and look at the U.S. economy right now. Just in the last 24 hours, think about what we're hearing from the old economy. Things like the airlines, the plane makers, Airbus coming out and saying things are going to be tough. The oil producers saying demand might not recover to where it was just 12 months ago. Then think about the new economy, Amazon investing in 100,000 jobs, NVIDIA doing a big purchase from SoftBank just going out there and buying call options in the equity market. Eric, they are two different worlds. How do you invest in either?
Yeah, I mean, I certainly agree with the premise of your question. There were arguably two different worlds pre-pandemic, and I think if anything, the pandemic's kind of exacerbated, those trends. Obviously, if you look at big tech stocks and take the past couple, what happened a week or so ago with SoftBank's option purchases and the little sell-off you saw in tech, it's almost been like its own asset class. You can almost think of big tech kind of as its own asset class, kind of almost disconnected from the rest of equity markets. And, I think, certainly big tech will, look to see if there's going to be a regulatory push against them, post the election, or not. But I do think, ultimately we're going to see, help toward the consumer, and we're going to see such loose monetary policy from the Fed that it will probably do two things. It will keep asset prices supported or even higher inflated than where they are now. It will also probably at the margin start to push up inflation and help on the consumer side of the economy.
Final question from me, Eric. Is it harder to be long growth or value right now?
Maybe I'll punt a little bit and push that question to my colleagues at Eaton Vance to focus more on the equity side. But I really think it's a question of, are you a momentum trader, momentum investor, or reversion to the mean? The momentum is clearly with growth, as you mentioned before. These companies are doing amazing things, and investors are putting more and more capital there. From a valuation perspective, clearly value's underperformed, and so at some point, if we see a real cyclical turn in the economy, I think you'll see some money rotate, out of growth and tech into value and into non-U.S. stocks as well. Who knows if we're there yet, but I think you'll eventually see that.
You won't be the last person to take a punt on this program. Eric, it's great to catch up. Eric Stein there of Eaton Vance. Coming up on this program, the Fed kicking off its two-day policy meeting. Priya Misra, good friend of this program, TD Securities Global Head of Race Strategy, will join us with a preview. That conversation is coming up next. 19 minutes away from the cash open in New York City. Equity futures just off session highs, sitting pretty through 3,400, up 0.9%, going into the open this Tuesday morning. Good morning to you all. You're watching Bloomberg TV.
Bloomberg Television is brought to you by Invesco QQQ, supporting the innovators changing the world. Invesco Distributors Incorporated.
Good morning, everybody. How you doing?
Here's a hint about how to make working from home less stressful and more comfortable. Make the switch to X-Chair. No matter where you put the amazing X-Chair, it instantly becomes the most comfortable place in any space. Infinite side-float recline and dynamic variable lumbar support make the X-Chair a customer favorite at home and work. Don't forget, the X-Chair lets you customize for the same measure of amazing comfort no matter what your size. And every model is in stock, ready to ship the next day.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
I do find myself, in terms of the economic cycle, being quite a fan of a significant V-shaped recovery. And every economic indicator I've been trained to follow, or virtually all of them for the past 30 years, are all generally pointing the same way in so many countries. And I think we're going to see a very strong bounce back in the third quarter all over the place and going into the fourth quarter.
Former chairman of Goldman Sachs Asset Management, Jim O'Neill, predicted a V-shaped recovery following some better-than-expected data out of China. Michael McKee with us now, Bloomberg Chief International Economics and Policy Correspondent. Got to say it, Mike, data's looking better than expected all round this morning.
Well, Jim O'Neill's optimism is admirable. Not everyone on Wall Street is convinced, however. Yes, it is true. The economic indicators we trained ourselves to follow over the last 30 years have been relatively good. We did get some better news out of China today. But the high-frequency indicators that we are training ourselves to watch now are more mixed. You can see here in the United States, there was a bit of a V-shape coming off the bottom, but then except for a bounce over the Labor Day weekend here in the colonies, John, we have flattened out. And that's pretty much true around the world. You look at the employment numbers in the UK today, 102,000 jobs lost. That's the most since 2013. Now, we do get retail sales in the States tomorrow, and except for cars, it is expected to fall back a lot. A gain, but not much of one compared to what we have seen. For Wall Street, the week isn't really about the indicators so much as what the Fed thinks of the indicators. Let me show you what we'll be watching tomorrow when they release their summary of economic projections, their view on where the economy is going. Of course, what we're going to want to see is GDP. Do they mark down or mark up their forecast? The ECB marked up growth a little bit for the next 2 years. Then on unemployment, this is the new key for them. So where do they think it is now? Where do they think it will end the year and next year? And that longer run, 4.1%, is that when we're going to start worrying about seeing some kind of inflation? They say no more. Inflation numbers then, they're saying we want to be symmetrical. We want inflation to go over 2% so we can average 2%. Does that 2% long run rate, does somebody finally say they want or they see inflation over 2% because they've never said that before?
Mike, industrial production just dropping across the Bloomberg. We've talked about a series of upside surprises. Here's a downside surprise for you on IP. It comes in at 0.4%. The median estimate month on month was positive 1%. The previous read, though, in a previous month, an upgrade there, 3.5%, a revision from 3% previously. Mike, you mentioned the Fed decision tomorrow. Take me into that news conference. Give me a feel of what you're expecting, virtually, of course, from Chairman Powell.
Well, we're expecting him to explain a little bit about those new economic forecasts from the Fed. And then there's going to be a lot of questions about what the Fed means when they say they want average inflation at 2%. How long do they let it run above 2%? How high do they let it go? Is there a trigger? The Fed's trying to maintain maximum flexibility. They don't want to say. We'll see how far Jay Powell goes in laying that out.
Do you think Mikey's got answers to those questions?
I don't think so, for a couple of reasons. One, it's going to take a very long time to get to 2% inflation, let alone above 2% inflation. And who knows exactly who's going to be on the Fed at that time. And the other is, like I said, they want maximum flexibility. If they think inflation is rising, even if it's just above 2%, but rising very quickly, they might be more inclined to act than if it were rising very slowly and stalling out above 2%.
Mike McKee, tomorrow will be interesting for people like you, I'm sure. And for me too, Mike. Good to see you. We'll see Mike a little bit later today and, of course, tomorrow morning ahead of that Fed decision. Priya Misra of TD saying there's a lot riding on the Fed's two-day meeting, writing the following. We think Powell will shift the narrative around QE and should clearly state that it's a tool to achieve the dual mandate via keeping rates low. Without that, long-end rates will rise a decent amount. Priya joins us now with more. Priya, build on that for us, the positioning for a steepener and the Fed's role in it.
Sure. Thanks for having me, John. So U.S. Treasury is funding a pretty big deficit, and they have taken strong steps to increase the duration of what U.S. Treasury is issuing. So they're issuing a lot of 10-year, 20-year, 30-year Meanwhile, the Fed is buying 80 billion a month, which is a lot, but they are buying it in a much shorter duration. So I think the fact that these auctions have gone okay, the fact that the long end is actually still stable, tells me that the market is pricing in some shift in language around QE. And I think it's the language around QE is stale, I would argue right now, because the Fed says it's for market functioning reasons. Market functioning is back to COVID levels and has been for a while. So our call is that the Fed is likely to make that narrative shift to say it's a tool to keep long end rates low. Now, as I think Mike was saying, they want flexibility, and I'm all for flexibility, but at least clarify the intent, clarify that you're willing to do what it takes. They need to buy more, they'll buy more. If they need to extend the weighted average maturity of their buying, they'll do it. I think we need to hear that from Chair Powell, because otherwise the long end is going to be extremely vulnerable, because we can all look ahead and project how much supply is coming. And if the Fed doesn't have your back, if you may, then those long end rates can be a lot higher at potentially the worst possible time where we're losing fiscal support as well.
So, Priya, what are you advising to clients at the moment on how they should position in the Treasury market?
I am long treasuries here in our model portfolio. I'm actually telling investors that there's, if we're in a 50 to 70, 75 basis point 10-year range, we are near the upper end of the range. And we've got some really massive risk events in the near term. We have the potential risk of a COVID spike. We're not seeing fiscal support. Now, let's see if this bill, this problem solver caucus bill goes through. But in a highly politically charged environment, if that doesn't go through, you're losing fiscal support. We have an election with a lot of process risk, as I call it, which is not knowing what the outcome might be on election night, plus the actual uncertainty around elections, which is very hard for any market to price because you've got binary outcomes. In that scenario, owning safe havens, long end treasuries, and the 2 years no longer a safe haven, because the 2 year, the 5 years, all anchored. So therefore you have to move out the curve. So I actually recommend that in the near term, if you've got risk assets in your portfolio, owning some safe haven assets actually makes sense.
Priya, you mentioned that range on 10-year treasuries, the top end 90 basis points since April, the bottom end 50 basis points. Many people are trying to work out how we break out higher, how yields increase. Bank of America put out their fund manager survey for the month of September this morning, and I wonder if anything like this resonates with you. I'll put the graphic up on the screen for everybody to see, but it basically showed that 41% of investors think it would take a credible COVID-19 vaccine to trigger higher bond yields. The next step was 37% looking for inflation, and then it was high debt levels, and then it was the election outcome and higher oil prices and all of that. But where does COVID-19 and a vaccine rank for you, Priya, in what could unlock Treasury yields to a breakout to the upside?
Right. I would if I was participating, I would have picked the vaccine and COVID as well, just because for inflation, I'm actually not sure, as much as I appreciate everything the Fed is doing, I'm not sure that they have the tools to really let inflation rise. I think it'll only come from the fiscal side because it's a demand shock. It's all about COVID. Do we get a pickup as kids are back in school and economies are reopening? Do you get that pickup? But on the vaccine point, do we get an effective vaccine? Is it distributed? Does everyone take it? And then is there any structural damage? So when I get the question, why does the Fed need to do anything? Interest rates are low. Well, part of the reason is some of it is priced in, some easing. Part of it is, what if you do get a vaccine? Do we want, big tightening in financial conditions because rates rise and then it shortchanges the recovery? Or can the Fed step in and say, we want to make sure that the structural damage is behind us, that we're really, the vaccine, the healthcare solution, give it time for that to work? Which is why I would say, even with the vaccine, it's the Fed response that's going to be extremely important. Hopefully, Chair Powell's asked this and he can respond that just getting a vaccine is not enough. We need to give it time to make sure it works and the economy is recovering. And then the Fed can take their foot off the gas. So it'll still come down to the Fed, I would argue.
Priya, thank you for always being generous with your time. I love catching up with you. Priya Misra there of TD. Coming up on this programme, the analyst action you need to know. That'll be next in our morning calls. And later, we're looking at the US's review of Oracle's TikTok bid. We'll do that with Jefferies analyst Brent Thill. Coming up on this program, your morning calls at the opening bell with equity futures punching higher, just off session highs, up 29 on the S&P. We advanced 0.9%. Europe doing better than okay too. The FTSE at 1.2%. The open just around the corner. You're watching Bloomberg TV.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Punchy start to the trading week with equities doing okay. Equity futures up 29 on the S&P 500. We advance almost 0.9%. That's the price action. Let's get you some morning calls to look at some of the analyst recommendations on Wall Street this morning. We begin first up with Deutsche Bank raising its MasterCard price target up to 383 with a buy rating. The analyst expecting transactions to continue improving amid promising demand for future travel. Next up, Bank of America upgrading Western Union to a buy with a $26 price target. The analyst citing the stock's underperformance and resilient customer-to-customer transaction trends. And your third and final call from BTIG upgrading VF Corp to a buy. An $88 price target. The analyst seeing catalysts for improving demand trends heading into the fall and winter season. That stock up by a little more than 1%. Next up, Oracle's TikTok bid, the subject of a U.S. national security review. Jefferies analyst Brent Thill joining us with his thoughts on the deal. The opening bell's up next, right here on Bloomberg TV.
Ada 3 kelompok pengungsi tersebut yang sudah berpencar arah. Kemudian kami dari Polsek Banda Sakti berkoordinasi dengan perangkat desa Kampung Jomblang melakukan upaya pengumpulan secara persuasif serta minta tolong kepada warga. Alhamdulillah warga yang terpecah semuanya berkumpul.
Going into the opening bell in New York City this Tuesday morning, S&P 500 futures having a little look at 3,400. We advanced 29 points, up 0.9%, up 1.35% on NASDAQ futures. Switch up the board into the opening bell with the bond market set up as follows ahead of the Fed tomorrow. Yields up by almost a basis point, a snooze in the Treasury market, range-bound for the last several months. 0.68% is your yield. And in foreign exchange, the euro just about hanging on to gains, but more broadly through G10, it is a dollar-weaker story. Top of the pile, the Aussie, the global growth and commodity proxy, that story is a stronger one this morning. Outside of that, into the commodity market, we advanced 0.9% on crude, $37 and around about 60 cents. That's the cross-asset price action at the market desk with your movers. Here's Bloomberg's Scarlett Fu.
You've got car makers and travel companies doing well. Let's start with Fiat Chrysler soaring after Fiat and PSA tweaking the terms of their merger deal, which includes cutting $3 billion from a special dividend to be paid largely to the Agnelli family before the merger. Meantime, Carnival is going to sell $1 billion of stock to shore up its balance sheet. Pete Deoterra says that that's an 8% dilution to existing shareholders. At the same time, it reported preliminary third quarter results, a loss of $1.7 billion, slightly wider than what analysts had been looking for. Nikola continues to swing wildly. Yesterday, it surged 11% after a three-day 30% loss. Today, it is back down 9%. Bloomberg learning that the SEC will now follow up a short seller's accusations of fraud with its own examination. And Sony says it is cutting its PlayStation 5 production target because of a chip shortage. These are custom chips, but manufacturing issues means it's only getting half the chips it should be getting. In July, Sony had boosted orders with suppliers because they expect a big holiday season with everyone stuck at home playing games. And let's move on to social capital. The blank check mania continues. The online home seller Open Door choosing social capital to go public. Open Door will have an enterprise value of $4.8 billion. I'm keeping an eye, of course, on Apple, up 2% right now, rising before the launch of its new products. This would be the first back-to-back gains for the stock in 8 days. And Oracle up by 0.6%. The whole TikTok saga is now in the hands of politicians. CFIUS is reviewing the bid and will make its recommendation to President Trump sometime this week. John?
I think it was always in the hand of politicians.
Yes,
this story, Scarlett, is just fascinating. Scarlett, thank you. Always great to catch up with you. 2 minutes into the session, equities advanced on the S&P 500, up 0.8%. IT, top of the pile, but every single sector is advancing this Tuesday. As Scarlett mentioned, it's about the politics now. Republican Senator Josh Hawley insisting that Secretary Mnuchin, chair of the U.S. Committee on Foreign Investment, should, quote, promptly reject any Oracle ByteDance collaboration and send the ball back to ByteDance's court so that the company can come up with a more acceptable solution. ByteDance has no intention whatsoever of relinquishing ultimate control of TikTok. Bloomberg's Sarah Ponczek joins us now for more. Good morning to you, Sarah.
Good morning, John. As you said, this has been a story that's been in the hands of politicians all along, but almost even more so now. This has been the big story to kick off the week. The fact that Oracle has emerged as the winner for that TikTok bid, and we saw a nice boost yesterday at 4%, and we see yet another move higher today, as you can see here. However, what now happens? Supposedly, Oracle is going to serve as something called the trusted technology provider. Now the proposal has gone to the U.S. government for this national security review. So here's what the Trump administration has said. According to Treasury Secretary Steven Mnuchin, if the deal is finalized, it would create what he called TikTok Global. Now, he said this is a unit that would have its headquarters in the United States, and it would also create 20,000 jobs, potentially a bit of a sweetener. However, the administration originally said that it wanted a sale of TikTok and a cut of that sale to go to the U.S. government. Now, as currently formed, it doesn't look like this would be the case. Rather, according to Bloomberg reports, it looks more like a corporate restructuring, and Oracle would have a stake in this new TikTok unit. So we will see what is to be had. As Scarlett said, CFIUS is reviewing this. Then they will give their recommendation to President Trump. It's as long as that is also under the review of the Treasury right now for the National Security Review, and we may hear in the next couple of days. However, even though politics has been very much involved, this hasn't deterred companies from doing cross-border deals this year. Take a look at this chart right here. What you're looking at is U.S. companies targeting Chinese firms for deals. Well, in 2020, this does not include that TikTok deal. Well, at close to $30 billion, we have actually seen the highest value of cross-border deals in at least a decade. So very much the U.S. government has more of a hand in the goings-on here, but as you can see, there's still plenty of action going on, John.
Hey, Sarah, thank you. Struggling to catch up with this story. Struggling to keep up. Sarah Ponczek, thank you very much. Jefferies analyst Brent Thill calling the TikTok deal insignificant for Oracle, writing the following: they badly needed a win against Microsoft, Amazon and Google, who are taking increasing share away from Oracle. Brent, always a good friend of this show, and great to catch up with you. I believe you called this a rounding error, so let's talk about that. Exactly what are they doing here? Is this a deal, M&A, or just a partnership? What is it, Brent?
Looks like a partnership on a technology side. Oracle's been stuck in high $30 billion of revenue for many, many years, and they're absolutely getting crushed by Amazon, Google, and Facebook. So they needed a win, and this will help them. Obviously, the color around this transaction is if they could successfully partner and provide the technology infrastructure, it would serve as a great reference client given the amount of data that TikTok creates. But at the end of the day, there are so many other demand drivers that Oracle should be more focused on than just this transaction. They have an enterprise